The conventional wisdom right now is going to be that this is Trump's election to lose.
Joe Biden and his campaign, even with all of the dysfunction, should not be counted out just quite yet.
There isn't a Trump trade or a Biden trade. You have to put Congress in the mix.
U.S. assets are probably likely still going to be attractive to the global community.
I think geopolitical risk continues to ramp up this summer.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with equity futures just about positive on the S&P 500. Coming into Tuesday, very close to all-time highs, coming off the back of a big rally for the small caps. The banks, the regionals, have been absolutely flying. Speaking of the banks, the day ahead looks like this. 6:45 Eastern time. We get numbers from Bank of America. A little bit later this morning, we hear from Morgan Stanley. Retail sales, 8:30. Then at the RNC, a week ago, we weren't looking for this. We are now. Nikki Haley speaking at the Republican convention. Plenty of headlines just yesterday from the RNC.
Absolutely. And the biggest one, of course, is Trump's VP pick. This is a VP pick for the base, Jonathan. He is not from a swing state, and he doesn't really broaden the appeal out. He's pretty much in the MAGA camp with the former president. But what does he do? He's able to speak to the Rust Belt. This campaign is going to make sure that this young man, J.D. Vance, of 39 years old, he's only been sworn into public office in 2023, is going to be campaigning where? Pennsylvania, Michigan, and Wisconsin.
That's the important word here, campaigning. The pick is about campaigning. It's not governance. It's not about governing. And if we talk about governing, I think that's where things start to get a little bit more confusing. What does this pick mean? Maybe for the policy platform of Donald Trump.
For the policy platform, this is going to be an individual who wants to be very tough on China, has questioned all the money going to Ukraine. And when it comes to economics, he wants to put those barriers up. He wants to put tariffs up coming in from China. He is definitely anti-big business, anti-technology. I thought one of the key voices yesterday that was so interesting at the RNC was the Teamsters head. Absolutely railing against big business and saying also we as a union are not beholden to anyone or any party. This is really a shift in the Republican Party, and J.D. Vance speaks to that. In his book, and he's talked about this in interviews, his grandparents who raised him are blue dog, union-carrying Democrats. Very different when he's going to be squaring off with Joe Biden, who says that he wants to be the most pro-labor union president.
If we get a Trump Volume 2, just how pro-business is that Trump Volume 2 going to be? We'll have that conversation throughout this morning. Check out the price action right now on the S&P 500, firmer by close to 0.1% on the S&P. In the bond market, unwinding some of the move from yesterday. Yields were up, now they're lower. We're down 5 basis points on a 10-year, 4.1789. Chairman Powell has confidence about the trajectory for inflation, just a little bit more confidence. Let's see how confident he feels about the consumer retail sales at 8:30, the one to watch there. Coming up this hour, we'll catch up with Jennifer Flitton of Invesco as Trump taps Senator J.D. Vance as his running mate. Andrew Sheets of Morgan Stanley as Fed Chair Jay Powell signals greater confidence. And Chris Marinac of Janney Montgomery Scott reacting to Bank of America earnings later this hour. We begin with our top story, Trump's grand entrance. The former president sporting a bandage over his right ear, arriving to a standing ovation at the RNC. His first public appearance since being shot in the assassination attempt over the weekend. Trump standing next to Senator J.D. Vance, the man he tapped to be his 2024 running mate. Joining us from the RNC in Milwaukee, Wisconsin, Katie Lyons. Katie, walk us through the next 24 hours where you are.
Well, it's going to be marked by more speeches. Really, the big event of the RNC this week was that vice presidential selection. That is what we had all been waiting for. Trump did that by design. He wanted to improve the ratings, he said, of the RNC by announcing the pick while we were in Milwaukee. So now that that is over and they have been officially nominated, of course, it will come to accepting those nominations. J.D. Vance is the vice presidential nominee, will speak on Wednesday. Trump will actually give his speech, which we understand he has rewritten in the aftermath of that assassination attempt this weekend, from being what he described as a humdinger to something more with a message of unity on Thursday. In the interim, we'll hear from others within the party, including, interestingly, Nikki Haley, who will speak today. And the question is that really the unity that Donald Trump is now speaking about? The idea that he did extend that invitation, which was not initially given to her after she competed against him in the Republican Party, trying to signify that the party is coming back together, coalescing around former President Donald Trump. Certainly he received not just a warm but almost overwhelming reception when he walked in, made his first public appearance since that shooting on Saturday. Yet last night here in Milwaukee, you can see the way the party is galvanizing around him. And of course, J.D. Vance, in many ways, an extension of Donald Trump, just perhaps a younger version at 39 years old, but still very much espousing those populist ideals.
Kayleigh, when it comes to the former president saying he's throwing out his speech and he's rewriting it, is that the sense you're getting on the ground from individuals that they are trying to actually lower the temperature?
Every single elected official I've spoken with since arriving here in Milwaukee on Sunday, Anne-Marie, has expressed a desire to lower the temperature, to tone down the rhetoric. And even when I was questioning a congressman from Ohio who is in many ways aligned with Senator J.D. Vance after J.D. Vance's pick, I mentioned to him that it was J.D. Vance who pointed a finger at President Biden, his campaign, and the left in the immediate aftermath of the shooting, saying that they were to blame for the assassination attempt. And I asked him, should Senator Vance, now as the vice presidential nominee, be changing his rhetoric? And his answer effectively was, we all need to do that. So, yes, it very much does seem that there is a tonal shift here at the convention. But I would say as well, in the conversations I was having with strategists in the days between Saturday and yesterday, when the selection was announced, there was a thought that former President Trump may not select someone like J.D. Vance because he has been such an attack dog, because he is known for aggressively defending Donald Trump, including with inflammatory rhetoric in many instances. And some thought that Donald Trump may not lean that way with his pick as he speaks this message of unity. But the thinking now is perhaps J.D. Vance is now going to be able to play that pit bull role, while Donald Trump, to the public, as he tries to, get independent voters or Nikki Haley voters, for example, more into his corner, can be more on that message of unity while he leaves the fighting to J.D. Vance.
Interesting. Kelly, fantastic coverage in the last 24 hours. Looking forward to the coverage over the next day or so through the rest of this week. Kelly Lyons of Bloomberg at the RNC in Milwaukee. Is that how you see it? Good cop, bad cop?
That's how Terry Haynes as well sees it. He picked someone that can go out and be the pit bull, shore up the base, but then Trump can come out and say, hey, I'm a unifier. I'm going to try to unite the country. But how long does it last? That's the question.
We've heard that word on repeat since the weekend. Unite, unite, unity, again and again and again. Joining us now to continue this conversation is Jennifer Flitton of Invesco. Jennifer, wonderful to catch up with you once again. Just walk me through your reaction to the pick just yesterday and what you're telling clients about it.
Yeah, I think you got it right in the opening. I mean, Donald Trump is doubling down on his brand, and J.D. Vance is very much an extension of who Donald Trump is ideologically, but also he is able to go out there and be that firebrand. He's able to deliver a message. He's rather eloquent. He's thoughtful. He's media trained from his time touting his book and sort of the philosophy behind that book, Hillbilly Elegy. I think we're going to see a lot of Vance, especially in that blue wall. Especially in the Midwestern states.
When it comes to campaigning, though, he's not from a swing state. So what do you think he really offers when it comes to trying to get Trump over the finish line when it comes to the Electoral College?
Yeah, that's right. Ohio is nailed down, right? It is now a ruby red state. I think Trump won it last time by 8 points. But he does reflect that Rust Belt sort of mentality, that blue collar, that working class mentality. And it's very much the expectation that he's going to go into a lot of those rural areas, those ex-urban areas that really brought Trump onto the scene and into the White House in 2016. It's very likely he will be deployed to that blue wall, which is, quite frankly, President Biden's best chance at retaining the White House.
When it comes to some of his former rhetoric, when it comes to J.D. Vance, an individual where he actually said that Donald Trump was Hitler-like in a text that was made public, an individual that said he wasn't going to vote for Donald Trump in 2016. Can he overcome this when he tries to go out and sell the Trump agenda?
Yeah, well, he has a little practice in sort of rewriting some of that history. When he ran for Senate in 2022, he had to explain that away. He might have to go a little deeper. I have a hard time thinking that any interview with Senator Vance is not going to start with that question from reporters, and they'll probably want to dig a little deeper. He has said he was red-pilled before running for Senate and really came on board with the Trump way of thinking and realized his alignment. But I think he's going to have to go deeper. This question is going to remain.
Jennifer, this is where the buzz is, the noise. Let's talk about where there's quiet. Tumbleweed, crickets, House Democrats. House Democrats were making so much noise over the last week, coming out, calling on the sitting president to step aside. That has gone very, very quiet. There was an interview yesterday evening. Only a week ago, we would have been calling that interview high stakes, right up until the tragic event of Saturday evening. How high stakes was that interview yesterday evening? And do you think we're done with the conversation we've been having over the last 2 weeks?
Yeah, I think for the general public, I think it was overshadowed, obviously, with last night and the Republican convention and Trump's entry into that. I think that's sort of the news of the day. But I can tell you Democrats were watching that. There are still a lot of private conversations happening now behind the scenes with the campaign and with President Biden himself. What will come out of that? Perhaps maybe the first sign is going to be this Friday meeting of high-level Democrats determining whether or not they'll have that August 7th virtual convention that could really seal the deal for the president's nomination prior to the convention in August. We'll have to see what comes from that.
Jennifer, if he were to step aside, what's the absolute final date for him to do so?
Well, I mean, for the purposes of the convention, you would want to allow for some sort of open convention, or there is the possibility that in the very final moments, they sort of surprise folks and then really allow for the pathway for Kamala Harris as being really the only option at that point. You know, a lot of the money is tied to the Biden-Harris moniker. And so I think the question really is if he'll pivot at all in the next month, because after the convention, it's very difficult. And then it's just in the hands of the DNC.
Jennifer, yesterday, a big conversation around this table and others as well was how this campaign was going to pivot ultimately, given that President Biden for a long time has been talking about Trump as an existential threat to democracy. It felt like following the conversation yesterday evening, they weren't going to pivot that much. Is that the way you read things?
Yeah, he had an interesting answer to that question with Lester Holt. I don't know if that was supposed to be his official answer. I don't know if we'll see some sort of further explanation of that going forward. I think it's going to be really hard, not just for the president and his team, but for the surrogates to really flip on the democracy issue, right? You're going to see a doubling down on the abortion issue for sure. But they really had a two-pillared message here going into this campaign. I want to think that we're going to have a unifying force, not just at the Republican convention, but the way in which we talk about politics. But there's something cynical in me that says, I think we might just go back to the way we've been doing things.
I think a lot of people share that sentiment, unfortunately. Jennifer, thank you. Jennifer Flitton there of Invesco. Let's get you an update on news elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. GM is backing down from its goal to produce 1 million electric vehicles. CEO Mary Barra telling CNBC at an event yesterday that the company won't have production capacity in place to build 1 million EVs at the end of next year, which was the previous target. GM is the latest legacy automaker to scale back its EV goals as momentum slows for plug-in models. Barra also saying customer demand will dictate how fast the company can get to that 1 million mark. Meanwhile, Hugo Boss shares plunging to their lowest level since 2021 after the company slashed its profit guidance for the year. The German high-end fashion brand citing weakness in key markets such as China and the UK. The company also saying profits plunged over 40% in the second quarter, and it expects an operating profit of around 350 to 430 million euros in 2024. That's a significant downshift from 430 million to 475 million euros it was expecting. And President Joe Biden will unveil a new proposal today to cap rental costs across the country. His plan would give landlords a choice, agree to cap rent hikes at no more than 5% per year, or give up coveted federal tax breaks. The measure would need to be approved by Congress, where it faces steep odds. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. One extra headline, a little self-indulgence, so forgive me. Gareth Southgate to leave his role as the manager of England's male football team after back-to-back finals at the Euros. Losing both, Gareth Southgate heads to the exit. That headline just crossed on the Bloomberg terminal moments ago. Up next on the programme, confidence building.
We didn't think it would be appropriate to begin to loosen policy until we had greater confidence that inflation was moving sustainably down to 2%. The 3 readings in the second quarter, including the one from last week, do add somewhat to confidence.
The conversation continues live from New York City this morning. Good morning. The Fund Manager Survey from Bank of America just dropping. Here's the latest on politics. You might be interested in this. Investors say trade policy to be most impacted by the US election. Ask for the impact of the US election sweep. So same party with the White House and the Congress, whichever party, by the way. 77% say higher bond yields, 52% say a stronger US dollar, 48% say higher US stocks. More on that in just a moment. Let's turn to the price action. Equities right now on the S&P 500 firmer by 1/10%. Yields back in. High yesterday, lower this morning. We're down 5 basis points going into retail sales. A little bit later, your 10-year 417.89. Under surveillance this morning, confidence building.
We didn't think it would be appropriate to begin to loosen policy until we had greater confidence that inflation was moving sustainably down to 2%. The 3 readings in the second quarter, including the one from last week, do add somewhat to confidence. Now that inflation has come down and the labor market has indeed cooled off, we're going to be looking at both mandates. They're much better balance. If we were to see an unexpected weakening in the labor market, then that might also be a reason for reaction by us.
So here's the latest. Investors looking ahead to retail sales data at 8:30 Eastern Time and a slew of Fed speak this week amid rising optimism for rate cuts this year. Andrew Sheets of Morgan Stanley expecting a September rate cut, writing this: the second half should see the paths of disinflation, growth and policy become clearer, setting up a constructive outlook for nearly all markets. However, what happens beyond that horizon is clouded by a wide array of uncertainties. Andrew joins us now. Andrew, we'll park the uncertainties for now. We'll talk about that in just a moment, particularly 2025. I think I know where that conversation's going. I want to talk about July. Jan Hatzius of Goldman came out yesterday and just said, why wait? So, Andrew, I've got to ask you, going into the July meeting, why wait until September?
Well, thanks. Good morning. It's great to be here with you. So I think there is a good case that the Fed should be easing policy. You have, as you just heard from Chair Powell, some weakness in the labor market. The unemployment rate is ticking up. Inflation is coming down. We've had 2 consecutive very good, i.e. very low CPI readings. And the Fed is well above neutral, kind of per its own long-term dot. So, the idea that policy should be less restrictive when the labor market's slowing, when inflation's coming down to target, I think that makes a lot of sense. Now, we still think that the Fed wants to see just a little bit more data to confirm inflation's coming down, and that's why they wait until September. But our economists, led by Ellen Zentner and her team, I think have been at the more aggressive end of Fed cutting. They think the Fed goes in September, September, November, and December. And that's also a reason why we think the curve steepens. So we do think the Fed should be easing. We think they start in September, but we think they do cut 3 times this year.
Let's get to that curve steepener, Andrew. You took us there. We saw that yesterday. It was driven by the long end, not by the front end. And I think the call at the start of the year was that you'd get that steeper yield curve, but really driven by rate cuts, the so-called bull steepener. What we saw yesterday was the so-called bear steepener. Treasury selling off on 10s and 30s, yields pushing higher, and there were political considerations in the mix as well. Andrew, when I reflect on that quote of yours and you start thinking about the uncertainties beyond the back half of this year, are you thinking about those political considerations a little bit more?
Well, absolutely. And I do think that's how the market is thinking about it, importantly. And what the market cares about does does matter. And so, if I think about how we are thinking about the yield curve and how our rate strategists are thinking about the yield curve at the front end, you do have this story of inflation moderation, some very good inflation readings, the Fed appearing to be much more balanced as they're thinking about the risk, and a Morgan Stanley rate cut call that has been calling for more rate cuts than the market's pricing in the near term. But I think the long end is more driven by potentially concerns around the fiscal path. And I think the market has looked at recent political events and thought that raises the chance that you get looser fiscal policy, a wider deficit going forward, and that can drive some steepening pressure on the curve. So that's still how we're thinking about it. Obviously, there is a lot of uncertainty out there, but for now, we're expecting the curve to steepen.
Right, and we're going to possibly get looser fiscal policy regardless of who's in the White House. But we do see a lot of people trying to talk about the Trump trade. And if that was to be the case next year in 2025, we can get tax cuts, we can get tariffs. We had Adam Posen say that would mean a hike on the table. What's your expectation for the Fed in 2025 when so much is unknown?
Well, so a lot is unknown. So I think if we try to break down this problem, I think it's true that fiscal policy, that the deficit is still there under both candidates. But I think under our modeling of the candidates' proposals, the deficit is wider under a second Trump administration, especially if you would have a sweep of Congress. And it's also, I think, more likely that a Trump presidency would coincide with a congressional sweep than a second Biden term. I think it's also the case where those tariffs do raise a lot of inflation uncertainty. And again, it will complicate the Fed's story, the Fed's message. Now, for the moment, we think that that's more likely to show up in currency markets. It's more likely to show up through a stronger dollar. But it is likely to create a lot of potential noise, and it could also increase inflation risk premiums going forward, which again could be another factor that we think could steepen the curve somewhat.
Andrew, when we start to think about who's vulnerable, obviously we start to think about China. UBS out this morning saying US tariffs at 60% would halve the growth rate in China. I think we have to go a step further, just one. The next logical step is to think about Europe. What would happen to the outlook for European inflation when all of these politicians and officials have been complaining about Chinese overcapacity? Doesn't Europe have to eat it if the walls go up in America? And what would that mean for the kind of exposure you take on the continent?
Yeah, so it does raise some serious questions. Again, we do think that deflationary or disinflationary pressures, I should say, are building. And that's a story in the U.S., but it's also a story in Europe. And we're pretty confident that inflation is going to come down. It's going to come down enough in Europe by September, where the ECB is cutting, that the Bank of England here in the UK is going to cut rates in August. And so this disinflation story is still there. But I'm glad you mentioned China, because that's, I think, another driver of this disinflationary story. You still have negative PPI coming out of Chinese industry. I think you do have some real uncertainties of how an economy would respond to potential tariffs. And again, going back to our what we were just talking about, there is an enormous amount of uncertainty here. But again, a weaker currency could be one way that you respond, and that could be also further disinflationary in terms of pressure into Europe. So a lot of questions. I don't think we've seen enough information to know exactly how Europe will respond. But yeah, I think the way we're currently thinking about it is there's already some of that pressure in train.
Andrew, what about the credit perspective exclusively, specifically? What would that mean for European corporate credit?
So I actually think credit's in a relatively good place. I mean, I think if we're looking at somewhat modest growth, lower inflation, the ECB cutting, and I think the type of risk we would see from that sort of a tariff or import pressure from China would not necessarily be a credit issue. It's likely to cause some dispersion. I think when we think about the risk of either tariffs or foreign competition, it's very idiosyncratic. The exposures differ a lot across our European universe. So I don't think it necessarily creates a credit negative story overall. We're still expecting spreads to be modestly tighter here over the next 12 months, but it could definitely drive some single name risk. And I think that's how we're trying to think about it.
Andrew, thank you, sir. Appreciate the update. We'll continue the conversation through the rest of this year, no doubt. Andrew Sheets there of Morgan Stanley. I referenced the fund manager survey coming out of Bank of America this morning. Number one risk, higher inflation is no longer the number one tail risk. Number one now, geopolitics. China, China, China. Once again.
And a lot of this is why they're saying also trade is the number one risk, or not risk, that's going to be the most impact when it comes to the U.S. election. Interesting, taxation and energy, bottom of the list. Although the Trump-era tax cuts expire next year. It's going to be tax Armageddon, as Senator Warner calls it.
More on that in just a moment. Coming up next, President Joe Biden defending his campaign rhetoric and looking to ease voter concerns in another sit-down interview. That conversation just around the corner from New York. This is Bloomberg. Take a look at this. The price action, just a snapshot. What do you see? What we've seen over the last week, the dominant story. The small caps once again. The Russell's up by more than 1 full percentage point. The S&P up by a tenth. Small caps were up 6% last week, up by something like 2% plus yesterday. Take the last 4 days. The Nasdaq's actually lower over the last 4 days. The Russell is up by 8 percentage points. The regional banks, that index, KBW Regional Banks Index, up 11% in just 5 sessions. Massive outperformance for small caps and regional banks. Switch up the board and get to the bond market. We've been talking a lot about steeper yield curves. Yields up at the long end. They're down this morning. We're down by 4 or 5 basis points on 10s and 30s. We're down 4 on 2s. The next stop for this conversation, retail sales, a little bit later this morning. 2 hours away, 8:30 Eastern time. Look out for that. Just another read on the US consumer. Just how many cracks are out there, particularly in the labour market. What does it mean for consumer spending? Yields a little bit lower on the session. Want to finish on foreign exchange. The euro, talked a lot about this with Andrew Sheets and Morgan Stanley. If you get Trump Volume 2 and you get another big round of tariffs in America, who eats Chinese overcapacity? It's got to be the Europeans. Who else is going to be doing it if they don't put the walls up? That's going to be a conversation for us for the next few weeks. Euro dollar this morning, 109.01. Under surveillance this morning, some top stories for you. Donald Trump picking Republican Senator J.D. Vance of Ohio to be his vice presidential running mate. Once a critic, now a fierce defender of Trump. Vance is known for his skepticism of the U.S. involvement in the war in Ukraine and has said China is the biggest threat to America.
Yeah, absolutely. He constantly talks about how the United States should be squarely focused in the Pacific instead of these wars like in Ukraine. He talked about the Munich Security Conference. He gave also an opinion piece to the New York Times. So foreign policy is going to come in focus here when it comes to this individual. And then also trade policy when it comes to China. He does believe, as the former president does, that the walls and the barriers need to go up. And he thinks this means that there'll just be more capacity in the United States to build goods and buy goods in the United States.
Now, a lazy conversation around this table would usually sound like this. Republicans, they're pro-business. And then you start to look at Senator J.D. Vance, and I think things get a little bit more confusing. His position on big tech, his position on mergers, seems to have more in common on those issues with Senator Warren than maybe the sort of conventional, stereotypical Republican position on them.
Well, when it comes to Senator Elizabeth Warren, she said actually she liked working with him. They were crafting legislation together when we saw those banks collapse and they want to claw back some of that executive pay. And to be fair to Mr. Vance, he went and said, we shouldn't treat all these banks the same, though. There's some smaller regional banks that we need to also look at potentially treating them a little bit different than these big behemoths. So he's always has those regional banks close to the American heartland in his mind when he goes after some of these big corporations. Also, another individual he said he thinks is doing a pretty good job in the Biden administration, which potentially gets a sense of where his mind is when it comes to M&A, is Lina Khan. So there's a sense in here that this isn't exactly going to be the Republican Chamber of Commerce pick when it comes to the former president's VP pick.
And if you're a bank hoping that maybe a Trump administration opens the door to easier M&A, there'll be questions about that. I think we have to ask the question, Anne-Marie, this morning. Do you think there's a risk we read too much into J.D. Vance's views and how they might shape Donald Trump's?
I think one thing, and what I hear a lot from individuals that know the former president very well, is that he wanted someone who was loyal and who could carry out his agenda. So I imagine there was a conversation that you're going to help me with my agenda and not path your own course. But again, as everyone has been talking about, this is an individual that has firmly lined up. Even though he was a critic in the very beginning, in his very short political history, he's firmly lined up with the former president on a lot of these policies.
That's the latest from the RNC, and that's just yesterday. Every campaign needs money, so let's talk about the money coming in. Elon Musk is pledging to pour $45 million a month into a pro-Trump super PAC. The news coming after Musk endorsed the former president in a post on X shortly after the assassination attempt on Trump at a Pennsylvania rally on on Saturday. It wasn't just Elon Musk that came out, Bill Ackman as well. You wonder if others will follow.
Well, if others will follow, the big names we're going to be watching is Ken Griffin and Paul Singer. Why? Because we've reported that they've taken a meeting with the former president, individuals that were critical in the past. Potentially, they are now going to swing their support on the former president. We don't know if that's happened yet, but there are talks involved. But Elon Musk dropping a ton of money into this race, firmly behind the former president, and I guess it makes sense with the J.D. Vance pick.
Watch this space. Think about how quickly the conversation has changed politically in this country, how the nation has shifted from one subject to another and how quickly we've done it. Only a few days ago, we were talking about a high-stakes sit-down interview with NBC for President Biden. It took place. Take a listen to what the president had to say.
Should they have anticipated what happened? Should they have done what they needed to do to prevent this from happening? That's a question that's an open question. There's very little focus on Trump's agenda.
Yeah, the term is bullseye.
It was a mistake to use the word. I didn't say crosshairs. I meant bullseye. I meant focus on it. I understand why people say, God, he's 81 years old. Whoa. What's he going to be when he's 83 years old or 84 years old? It's a legitimate question to ask. I've seen pieces of it. I've not watched the whole debate. Lester, look. Why don't you guys ever talk about the 28 lies he told? Where are you on this? Why didn't the press ever talk about that? 28 times.
Is there a sense of wanting to get back on the horse?
I'm on the horse. Where have you been? I've done 22 major events, met thousands of people, overwhelming crowds.
Anne-Marie, the president, back in campaign mode.
Where have you been? He's asking Lester Holt, saying, haven't you seen me out and about campaigning? The reality of what the president sees as him out there is, I think, very different than the reality and perception for American voters who are still questioning whether or not he could be the top of this ticket, including in his own party. So a lot of this has gone a little bit quiet since the assassination attempt on the former president. But it doesn't mean that it's come to a complete halt. And that interview there, when he was confused about whether or not he said himself bullseye or crosshairs, I don't think that's going to stop the concerns about whether or not he is too old to be the Democratic nominee.
Let's get into that right now. Joining us to continue the conversation, Antjuan Seawright, the CEO of Blueprint Strategy and a Democratic strategist. Antjuan, wonderful to have you with us this morning. Thank you for joining us. I just want to go to the conversation that dominated political conversations around the world for the last 2 weeks before the weekend. And that was President Biden and whether he'd be at the top of the ticket come November. Do you think we are ready to unite behind one candidate in the Democratic Party?
Well, I certainly think it's a must, not a plus. We've seen what has happened in our party when we are not united on all fronts. The residue and the aroma of the 2016 election still lingers, especially when you consider the actions of this right-wing activist court that the former president was able to appoint not one, not two, but three appointees to, not to mention the downstream effect of judicial judges at the federal level. And so we still feel the residue of that. And I think it's so important that we learn from our mistakes in the past. And quite frankly, Joe Biden and Kamala Harris have been two of the most consequential leaders this country has ever seen. There's not been a constituency in this country, whether you voted for them or not, who have not benefited from the Biden-Harris administration. Our country's economic bill of health reflects that. I think the social bill of health of this country reflects that. And certainly, when you look at their legislative agenda, there is no comparison in modern day history, perhaps in the history of our country.
Then why not pass the torch to VP Kamala Harris?
Well, he doesn't need to. The fact of the matter is 14 million people in the Democratic primary in 2024 voted for the two of them to represent us. They have been dynamic as a duo. There's no need to change what's been good for the American soil and certainly what's been good for our party. They've been able to accomplish the things they've been able to accomplish with some of the slimmest majorities in our nation's history. We cannot walk away from that. That means even though Republicans may have voted against the legislation, voted no, when they went back home to their districts, they took credit for the dough. That's a reflection of who Joe Biden and Kamala Harris are as leaders. I think that's what they represent now. And certainly their vision for the first 100 days is very reflective of not where America was, not where she is, but where she needs to be.
Following the assassination attempt on Trump, we saw the campaign swiftly take down TV ads. They're talking about wanting to lower the rhetoric. Do you think the principle of this campaign, which is that Donald Trump is an existential threat to democracy, can still stand? Can they still campaign on that message and use that rhetoric?
I think so. The fact of the matter is, when you think about basic fundamental freedoms as we know them, the former president still presents a threat to those things. For me, as an African American, whether it's voting rights, for women, whether it's being trusted to make their own health care decisions, and those decisions remaining between her and her doctor, for children who are trying to access SNAP benefits, for the younger generation, who includes myself, by the way, who believe that the climate crisis is a real thing in this country and we must deal with it in an aggressive way. There are a number of things that we can point to that Donald Trump presents a threat to. And then when you add the fact that he is a bullhorn for Trump's Project 2025, and we know the threats that come along with that policy agenda, certainly I think we have to remind the American people about what Donald Trump presents, but also what he was after spending 4 years in the White House.
Let's talk about the math quickly. The current president needs to hold Michigan, Wisconsin, and Pennsylvania. How difficult is that going to be that now the former president, Donald Trump, tapped J.D. Vance, an individual who is very good to speaking to the concerns of the Rust Belt?
Well, elections are about people's rhetoric. I do not think we can fall into the trap of having a personality conversation, but certainly we must have a policy conversation. And when you think about who J.D. Vance is, both as a senator and as a person, he is once again another page in the catalog of right-wing election-denying extremists. He is an evangelist for Trump's Project 2025. He does not believe that women should be trusted to make their own healthcare decisions, i.e., including a 10-year-old rape victim in his own state of Ohio. He was instrumental in killing the bipartisan border legislation in the United States Senate, and certainly he's been vocal about ending Medicare and Medicaid as we know it. And so when we lay out the case and we put muscle mass and muscle memory to the Vance-Trump or the Trump-Vance ticket, and we continue to make the case on the Biden-Harris record, but also the vision for the future, I'm confident that the American people, Democrats, Republicans, independent thinkers, and independent voters will make the right decision, just as they have in every single election since Joe Biden and Kamala Harris have taken office.
Antjuan, thank you for sharing your opinion this morning. Antjuan Seawright there of Blueprint Strategy. I want to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Israel is engaging in talks about withdrawing from the Egypt-Gaza border, according to a report from the New York Times. The issue is seen as a gateway to a long-term ceasefire. Israeli officials are reportedly open to the move as long as Egypt agrees to work to prevent arms smuggling along the border. Meanwhile, China is preparing to host leaders from the two rival Palestinian political arms, Hamas and Fatah. They will meet in Beijing next week to discuss Gaza's day-after plans. Shares of Trump Media sinking in the pre-market after the company registered 38 million common shares. The pact with Yorkville advisors would dilute existing investors with as much as $2.5 billion in common stock. This coming after Trump Media shares rallied as much as 31% yesterday, the biggest upside move since March. But the stock has been volatile, moving with polls on the election. And England football manager Gareth Southgate is stepping down after 8 years in the role. The announcement coming just days after England's loss to Spain in the Euro final. Southgate was appointed back in 2016 and helped restore English football to high levels of competition, reaching 2 straight Euro finals and the quarterfinals at the World Cup. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Numbers from Bank of America just around the corner, with equity futures right now on the S&P 500 firmer by 0.1%. Up next, wrapping up earnings on Wall Street.
The net interest income comparisons for all the banks on a year-over-year basis has been negative, with the exception of JP Morgan. I think that's going to be one of the biggest trends that most investors will focus on.
A sneak peek of BofA. Investment banking revenue coming in at $1.56 billion, the estimate $1.45. More details on that up next. 6:45 Eastern Time. Equity futures on the S&P 500 firm up here by 0.1%. Under surveillance this morning. Bank earnings wrapping up on Wall Street.
The net interest income comparisons for all the banks on a year-over-year basis has been negative, with the exception of JP Morgan. I think that's going to be one of the biggest trends that most investors will focus on. They're looking for the inflection point when net interest income growth on a year-over-year basis turns positive. We expect it to happen in the second and third quarter of this year.
Just getting numbers from Bank of America to wrap up some of those earnings on Wall Street. B of A just dropping, Morgan Stanley a little bit later with the numbers. Here's Shanali Basak. Hey, Shanali.
Good morning, John. Not only do you have Bank of America beating on net interest income as well as on trading led by equities trading, very importantly, you have Bank of America giving guidance for what they expect to bring in net interest income later this year. They expect that number to jump from the $13.9 billion you're seeing in the second quarter to about $14.5 billion. So an increase through the end of the year in net interest income. That guidance is critical. What do they expect this to come from, John? That's the most interesting part. You remember maybe those held to maturity securities that have been dragging on Bank of America stock the last couple of years. They believe that they could reinvest these securities, and what we understand is about $10 billion roll off per quarter, so about $40 billion a year, now into higher yielding treasuries. This is also a reinvestment of assets like mortgage loans and auto loans that had been extended at lower interest rates, now moving into higher interest rate products. So higher for longer, helping Bank of America out. A little bit of a lift in the stock pre-market, as you can see. Of course, a strong read here across the board. Real quick note here on credit quality. You have provisions for loan losses meeting expectations, charge-offs about meeting, coming in just a little higher than expected. Charge-offs of $1.5 billion, relatively flat from the first quarter and up from $869 million in the second quarter of last year.
Shanali, just want to talk about trading revenue. Decent beat here. I want to sit on that a while longer. $4.68 billion, the estimate $4.53. 0 days of trading losses in the second quarter of 24. I'm looking ahead to Morgan Stanley now at 7:30 Eastern Time. How high is the bar for Morgan Stanley now?
Very high, John. And the reason being, we talked about it a bit yesterday. You might remember Goldman ended yesterday at an all-time high. And when you saw their equities trading number, it came in above JP Morgan's and above where Morgan Stanley is expected. This has been a traditional, very historical rivalry. All of these banks are leaning hard into their hedge fund clients, really leaning on that prime brokerage at a time where markets are still volatile, and clearly these trading desks are benefiting from them.
Hey, Shanali, tremendous work. As always, we'll touch base with you when Morgan Stanley drops. Bank of America just behind us, up in the pre-market, up big time so far this year. Year to date, B of A up 24%. Goldman's up about 28. Morgan Stanley has really lagged. Year to date, it's up by about 13. Still a decent year, but it's lagged the pack. We'll hear from Morgan Stanley in the next hour or so. Joining us now to talk about bank earnings is Chris Marinac of Janney Montgomery Scott. Chris, wonderful to catch up with you, sir. We've got a lot to talk about. It's particularly the rally in small caps and the regionals, but I want to start with the earnings from the big players on Wall Street first. We've had JP Morgan, we've had Citi, we've had Bank of America. What stands out for you, not just this morning, but over the last week?
Well, net interest margins aren't really increasing yet, John. I mean, I think we have this final quarter where margins bottom. You know, we're happy that the cost of funds at B of A was only up marginally, so they're still the leader in terms of low-cost deposits. I think that yields are going to get better as things roll over on the upside, but the cost of funds has to come down. That's where the Fed policy, the possible shift in interest rates, third, fourth quarter could be very useful. I was very thankful that the criticized loans were flat in the quarter from Q1. Charge-offs only up 1 basis point. The provision was higher. They did build slightly, but I think overall that was a win as well. But you're not really seeing the big revenue growth on the spread side. Investment banking, as you mentioned, was definitely higher, so no issues there. That was a beat. I think expenses acted well, but no major surprise on the expense front.
Chris, I went through the year-to-date gains for the stocks of some of these major players. If you go over the last 12 months, you can double it. They've been tremendous. Chris, there was something about this environment in the last year that has been particularly good for the bigger players in the financial world. Is something changing, Chris, where you think things get better for the smaller, the mid-sized banks, the more regional players?
Sure. I think on the regional and the smaller players, I think what you have is the cost of funds is beginning to crest. That was the major challenge even before you had the Silicon Valley and First Republic failures last year. I also think that, generally speaking, the expense leverage in this business is very good. We've seen banks much more efficient today than they were 15 years ago, John, and that's a tremendous difference. The cost of technology is helping banks do more with less. I think they're getting much more efficient with their staffing. They still have to spend money, but I think they're much more efficient at doing so. So I think as we get to a period where the cost of funds comes down or at least flattens out, that's going to lead to better spread income. And I think overall the expense leverage is still there for the industry.
The move in regional banks over the last few days has been absolutely phenomenal. Chris, I think we're up by something like 11% in just 5 days. There was a note from Citi just yesterday from Scott Kroner. I'm going to share it with our audience. Maybe you've seen it. Overweight US banks, our preferred Trump trade, easier valuation setup, stable fundamentals, lesser tariff risk, combined with incremental deregulatory inertia, give this sector a good risk-reward setup. It's the conversation in the moment, Chris. How would Trump's second term influence, shape the performance of these stocks?
Well, John, for sure, the regulatory environment's going to shift. I think regulation can very much have peaked in terms of the angst in the industry. Under a new administration, you would see regulations change dramatically. I think it would take about 18 months to really affect. The rank and file do not change that quickly just because the head of the White House changes. But it is going to be a perception shift, which is going to be anticipated and already is by the stocks. The banks were trading at 48% relative multiples last week. Today, they're 53 or 54 relative PE to the S&P. That has a long way to go because we used to be at 66 to 70%, median range for the last 10 years. So there's a lot more valuation recapture. The regulatory perception change is a massive one. We have to see the follow through in the fall, but that certainly is a very good start the last several days.
We heard J.D. Vance, the former president's VP pick, in the past talk about big banks, but also talk about regional smaller banks. He says community lenders, he thinks they operate at a financial disadvantage to the biggest banks. Would that be another reason why to potentially put on trades for some of these smaller regional players?
Well, sure. I think you have to have a regulatory framework that's going to fit the community banks and it makes it easier and less onerous on them. I think having the trickle down to the same regulation applied to a $100 or $200 billion bank on one that's $1 billion or $2 billion is just very difficult to execute. It gets back to the opposite of the expense leverage I was mentioning. So if we can have relief there, that is a tremendous shift. I think that is a possibility. I do think it takes time, but that absolutely happens. The small banks are the major lenders in the country. Small businesses are still they generate the new jobs, the new activity in the country. That's where community banks really do their best work.
Hey, Chris, wonderful to hear from you, sir. Appreciate the setup there for the big banks this morning and the regional players as well. Chris Marinac there of Janney Montgomery Scott. This is one of the conversations at the moment. The outperformance we're seeing in small caps and the regional players. I mentioned KRE, the regional bank index. 5 days, we're talking about double-digit gains across 5 trading sessions.
I'm obviously looking into political rhetoric for some of this. After the collapse of SVB, what did we hear from Senator J.D. Vance? He sits on the Senate Banking Committee. He says the executives responsible for running their banks into the ground are sitting on millions of dollars in compensation and bonuses. Meanwhile, the American people are bearing the financial burden for their excessive risk-taking and gross mismanagement. But he likes to talk about and prop up this idea of community lenders, regional banks close to people at home that he's serving in Ohio. And this is the message he's going to take to the Rust Belt.
How different would it be if it wasn't the likes of President Trump and J.D. Vance and we got President Biden, Kamala Harris, Volume 2? How different would it be for the banking sector?
Well, the idea here is, at least in the legislation I was looking at overnight, trying to remember where exactly J.D. Vance lined up with Elizabeth Warren, that's where it is. And there's a lot of Elizabeth Warren acolytes in this Biden administration, and some of them line up when it comes to things like big tech, antitrust, big banks. They line up squarely next to J.D. Vance.
Pause, because I think we have to talk about this. The party of Reagan is a long time ago. Even the party of Paul Ryan is a long time ago. The makeup of Congress right now, what is the Republican Party and how pro-business is it in the sort of conventional, stereotypical sense?
It's divided, I think, is the fair way of putting it. And I think this was on display last night when you had the Teamsters head come out and rally against big business at the same venue where you're obviously going to also have maybe a representative from the Chamber of Commerce. These are the two different paths for the Republican Party. J.D. Vance squarely sits in one, as opposed to maybe someone else the former president could have chosen, like a Nikki Haley or a Glenn Youngkin. He is sitting firmly, his ticket in the base of the Republican Party right now, which is not always friendly to big business.
We've got a lot to talk about in the second hour of Bloomberg Surveillance. Here's the lineup for you. Coming up next, Henrietta Treyz of Veda Partners, Dan Greenhaus of Solace, Robert Koenigsberger of Gramercy Funds. Look out for that conversation. Robert on EM and what a second round of Donald Trump could mean for emerging markets worldwide. We'll also speak to David Malpass, the former World Bank president. A lot still to come from New York. This is Bloomberg.
Policy changes that could come in the first 6 months alone of next year are probably the greatest that I have ever seen in my lifetime.
If we get increased geopolitical risk, it's going to come with a slowing economy.
Markets can't resist the idea that there's going to be some sort of seismic swing, and yet over the past few cycles, it really hasn't happened.
The reality lies in the results. And I think we're going to see the results over the coming weeks.
It's an interesting inflection point, and we will see who can take advantage of that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance begins right now with equity futures positive by 1/10% on the S&P. This is what the day ahead looks like for you. We've had numbers from Bank of America. Later this hour, we'll hear from Morgan Stanley. Later this morning, 8:30 Eastern Time. Do not miss retail sales. Then at the RNC. I said this earlier this morning. This would not have been on the schedule until Saturday evening, when a phone call was made between the former president, Donald Trump, and Nikki Haley.
And also the fact that Donald Trump is talking about not just uniting his party with you showing support, reaching out to Nikki Haley, asking her to come in and give this address to try to do that, but also he himself says that he's throwing out his old script. This speech he's going to be delivering Thursday evening, and he wants to talk about unifying, which is why Terry Haynes says he picked J.D. Vance. This is an individual that can be the attack dog in the camp, and Trump can act as the unifier in chief.
I can tell you for investors unifying around one thing right now, small caps. Check out the futures board again this morning. We've seen this repeatedly over the last week. The S&P's up by 1/10. The Russell's up by more than 1 full percentage point. We're lucky that Danny Berger's back in the studio with us. Danny, this theme continues.
It's got everything going for it at this moment, up more than 1% for the past 4 days. You think about the bond market and how much it can really get more juice from trading the Fed. It can't really. It already has 2 cuts priced in. What's been so unloved with rate cut expectations is small caps. So put that in the positive camp. And then you get the debate, and then you get a deregulation potentially from Donald Trump, what that means for regional banks. And then you add in to that J.D. Vance and his dislike for big tech. I mean, there's so many things going for the sector right now.
Can we get to the Senator Vance point first? He has not missed the big business. Are we saying this administration, if we get a second term, are we saying it's all about the small caps?
Well, at least the vice president is. And I guess the question still remains, how much can he influence Donald Trump? But look, I think there's been some confusion to say, I don't understand. Why is Silicon Valley behind this guy? Why would big tech like him? I mean, we need to remember that Silicon Valley right now is small tech. And that is his background. He's a guy who saw SVB happen, and everyone came and lobbied to him and Elizabeth Warren. His background very much so is not for the big tech of the world. And that's a potential risk to what has been the high-flying sector of this bull market rally.
Key point there, Danny, which is whether or not he can influence the former president. It's the opposite way around. He will be signing up to former President Donald J. Trump's agenda, and he is going to see that through. So if Trump gets a phone call that needs to maybe back off some of these big business issues, I think J.D. Vance is an individual that's going to get in line. And he was chosen, I believe, partially for his loyalty to the former president that he has shown.
Is it the economics? Is it the Federal Reserve? Is it the politics? At the moment, it's all working for the small caps. The Russell outperforming. Equity futures on the S&P positive here by 1/10%. The scores look like this in the bond market. Yields lower by 5 basis points, 417.89. There's a big data point a little bit later that might shake up this market. Retail sales just around the corner. Corner at 8:30. Coming up on this programme, we'll catch up with Henrietta Treyz of Veda Partners as Donald Trump picks J.D. Vance as his VP, Dan Greenhaus of Solus with stocks near all-time highs, and Robert Koenigsberger of Gramercy Funds on what a second Trump administration could mean for emerging markets. We begin with our top story, Donald Trump announcing J.D. Vance as his running mate. The two appearing side by side at the Republican National Convention, the former president sporting a white bandage over his ear in his public appearance, the first one since the attempted assassination. Bloomberg's Kelly Lyons joins us now from Milwaukee, Wisconsin for more. Kaylee, Nikki Haley, we need to start there. Nikki Haley would not have been appearing if it wasn't for the events, the tragic events of Saturday evening. What is the content of this address going to look like, going to sound like a little bit later?
Well, we have heard Nikki Haley's tone around Donald Trump itself change since he dropped out of the Republican primary all those months ago. Of course, she was not initially invited to this convention. And the fact that Donald Trump did make that extension over the weekend in the aftermath of the attempt on his life does show that maybe there is some serious behind this messaging around unity that he says he's going to start espousing more and recrafting his speech on Thursday to address. So when Nikki Haley speaks later on this afternoon, she is likely to say some similar things about the idea that the Republican Party, especially those voters who cast their vote for her, would now need to unify around this ticket, which of course is now Trump-Vance 2024. She had previously said when exiting the race that those voters who cast a vote for her during the primary process, Donald Trump needed to earn those votes. So what I'm really curious to see is if Nikki Haley suggests that he has now done so, if she does outright endorse him, which of course she has. She said she's voted for him, but also say that everybody needs to circle the wagons and cast a vote for him. It's all part of this tonal shift that we are now seeing at this convention in Milwaukee and will see in the days to come. Everything seems to have changed very much since Saturday, although perhaps not the selection that Donald Trump made in his vice presidential pick, as he still went with an attack dog in J.D. Vance.
And the attack dog that he's going to put squarely in the Rust Belt. This individual is going to be campaigning in these three critical swing states, which, Kaylee, new polling out today shows the president is down in all of them. What's the message that you think J.D. Vance is going to bring to Pennsylvania, Wisconsin, and Michigan?
Well, those key states in particular, the Rust Belt states, is where he has the most obvious appeal, given that he is from Ohio. He outlined in his memoir, Hillbilly Elegy, his upbringing in a town that was plagued by a number of issues and poverty due to the manufacturing decline in that area. So in some sense, those are the kind of voters he can reach. We know he has been very outspoken, for example, in regard to the steel industry, which has ties not only to Ohio, but Pennsylvania as well. Even a separate swing state, Georgia, when I spoke with the governor, Brian Kemp, yesterday, he said the messaging power of J.D. Vance does have the appeal to apply to all swing state voters. The idea that he has an ability to articulate well the economic policy of Donald Trump and why it may work better for people who are hurting in their pocketbooks than what they've seen under 4 years of the Biden administration. I would also note, while we talk about the appeal J.D. Vance may have with working class people, with these kind of ideas of populism, he also does have a lot of influence with powerful people with money, knowing that before his political career began not all that long ago, considering he's only held his Senate seat since January of last year, he was a venture capitalist. He is a Peter Thiel acolyte. Peter Thiel is one of his biggest backers who could now contribute financially to this campaign. And of course, there's other billionaires who have come out in support of this ticket as well. Elon Musk expressed his happiness with the selection of J.D. Vance yesterday, and new reporting from the Wall Street Journal today suggests that Elon Musk is preparing to contribute $45 million per month to a new PAC supporting Donald Trump, the America PAC, that is going to focus on turnout. And we know turnout is going to be key ultimately in deciding the outcome of this election.
Big money. Kenny Nice, thank you from the RNC in Milwaukee, Wisconsin. Let's take some time to try and answer some of the questions I know you've all got. Joining us now is Henrietta Treyz of Veda Partners. Henrietta, one of those questions, it sounds a little bit like this, and these are my words, obviously. Donald Trump is a Dow Jones kind of guy. He's big business. And typically the stereotype around the Republican Party is they are the party of big business. They are pro-business. Are we saying that he's going to become a Russell 2000 small caps kind of guy? Is this going to be the outlook for the second term of Donald Trump?
You know, I've been spending a lot of time on the tech space and their recent formation of a super PAC. And as you just mentioned, decisions by Elon Musk to donate considerable sums of money over the next couple of months as we go into the final four of this election cycle. And what I have to recall every time is the way the trade war was orchestrated, where then Treasury Secretary Mnuchin and Ambassador Lighthizer and others were granting licenses and exclusions that ultimately led to lower tariff rates under Trump than there were under Biden. And I have to translate that to what the business community and the tech sector is seeing right now as the potential. They have an in to J.D. Vance. They have been a part of his campaign since he ran for Senate the first time. I think what the business community, as well as the international community, including the European Union, have seen in the last 8 years is that they can have a more direct line of communication that leads to exclusions, grandfather clauses, and licenses under Trump than they could under Biden. And that explains a lot of it, in my opinion.
That direct line, does that mean that the big business goes to the top of the ticket, Trump, and it's the smaller, maybe smaller tech companies that go to the bottom of the ticket, J.D. Vance?
I think that makes perfect sense. And I think it makes a lot of sense to see how they fill out any potential cabinet secretary positions. One of the things that I focused on a lot this year is the fact that a number of these potential candidates for a second Trump term are not going to be eligible necessarily for 60 votes in the United States Senate to be confirmed. So there might be a lot of acting cabinet secretary officials. Those could be more extreme people. And if the administration is not particularly bothered about having an acting secretary for a while, then that's somebody who could have the ear of business, the ear of small business, Russell or large cap names that can get directly in. There are a whole host of ways and anybody that they know. So it makes sense that they get involved now. I would also point out that the Teamsters Union has decided that they are not going to necessarily endorse Biden this year, after supporting Democrats for the last 2 decades, going back to Obama in 2008 and well before that. And I think that's a major indicator of how deeply insidious the Republican ticket has been on the Democratic blue wall in Rust Belt states. And J.D. Vance, hailing from Ohio, and the events in Pennsylvania, I think really serve the Republican Party right now.
Teamsters president last night, I think he had the longest time allocated to him to give this speech. He says we're not beholden to anyone. Is there a potential that we are seeing a shift of pro-labor union individuals supporting Republicans? And this was supposed to be a main pillar of President Biden.
Yeah, this has been going on for a long time. And what's really remarkable is, if you've spoken with anybody in the Biden campaign for the administration for the last 4 years, you know that they have bent over backwards to provide for the labor unions. Scranton Joe talks about it all the time, their trade policies, even to the detriment of the environmental lobbies. And they really try to walk a fine line, but it's not working. The 1.3 million people strong Teamsters Union that's integral to Nevada, Michigan, Ohio, Pennsylvania, they're saying we're not necessarily going to endorse Biden this year. They're not even scheduled to speak at the DNC yet.
Henrietta, somewhere else that Trump and J.D. Vance are very closely aligned is when it comes to foreign policy. Vance speaking yesterday to Fox saying China is the U.S.'s number one enemy. He gave an interview to Politico over the spring saying that he was for devaluing the dollar. The market, for the most part, has written this off as just campaign rhetoric. Does J.D. Vance as vice president mean you can no longer do that?
I don't think you should have written this off as rhetoric. Regardless, I think the former president illustrated he's extraordinarily clear about his approach to tariffs on China. I think that they are the number one offset in the tax bill plan. That tax bill will cost $4.6 trillion. So even if you don't believe the rhetoric around the international relations, believe the rhetoric around the deficit. $4.6 trillion just to keep tax rates flat is no laughing matter. I think that depending on the size of any Republican majorities in the House and Senate, you may or may not get the $1.2 trillion SALT tax cap. That would be a major dent in the deficit hike that will be imposed by the 2025 tax bill. And the former president's plan is to impose tariffs in order to offset the cost of that bill. So you're going to need those tariffs come hell or high water. They need the revenue.
We've got to squeeze this in. Last time we spoke, you said there was a really, really strong chance that Joe Biden wouldn't be top of the ticket come November. He'd have to step aside. Events happen. It feels like we've been overtaken by events, particularly what happened on Saturday evening. Have you changed your mind on that call, or are you sticking with it?
I think that the events of Saturday helped former President Trump, secure a lot of groundswell of support and galvanization from his base. And I think it created some breathing room for Joe Biden that is obviously changed the circumstances. So one other thing I would point to is that the DNC is trying to move up their vote count to start July 29th and end on August 5th. So there are a lot of things working in Joe Biden's favor right now as well.
Henrietta, we appreciate your time. Henrietta Treyz there of Veda Partners, breaking down a situation in the Republican Party and the extra time that the sitting President Joe Biden's ultimately been granted here.
He has been given a lot of time. One, because that interview yesterday started, of course, with the attempted assassination attempt on the Republican candidate, Donald Trump, and the former president, but also the VP pick. It's sort of taken the oxygen out of the room, given Biden this breathing room to not face the calls every day of, well, this is potentially a make or break interview. This is potentially a make or break campaign stop. He was defiant yet again in the interview last night. Even though there was times he struggled to form his sentences, remember exactly what he said, he was still defiant, which is why the whispers are quiet right now.
Sure.
I don't think they've gone away.
Look, if we didn't have the events over the weekend, let's just make that assumption. I know that's tremendously difficult to do. Let's just say we had that interview yesterday evening and the president delivered his responses in the way that he did. We'd have more House Democrats this morning asking him to step aside, without a doubt.
Absolutely, because they would have felt emboldened once again that this performance was not good enough for the job to be president of the United States.
That's the latest in Washington. Here's the latest elsewhere with your Bloomberg brief. Here's Yahara Hakez. Hey, Yahara.
Hi, John. We start with Bank of America. Those shares are up in the pre-market. The company reported trading revenue, excluding DVA, in the second quarter that beat analyst estimates. Bank of America also reported investment banking revenue that came in above estimates. There was also some insight into the health of the consumer. BofA said net charge-offs increased by more than 76% due to, quote, higher credit card losses. Sagenti Capital Management has returned more than 90% of its clients' capital less than 2 months after it told investors it would shut the firm and return their money. The multi-strategy hedge fund had about $4.7 billion under management at the end of May. This coming as its founder, Simon Sadler, and ex-trader Daniel LaRocca will be going to trial over accusations of insider trading. And Match Group, the owner of the dating app Tinder, is facing its third activist investor this year. Starboard has built a stake of more than 6.6% in the company, according to a letter reviewed by Bloomberg. The investor plans to push for a sale of Match if the company fails to turn around its operations. This coming as online dating companies have been struggling with slowing growth and challenges in retaining paying users. That's your Bloomberg brief. John?
Yahara, thank you. Up next on the program, the big rotation.
I think the big question is, as we get this rotation, can it occur without selling of big cap tech to buy small cap? Does AI continue to lead the way, or do we get a rollover?
We'll continue that conversation next. Live from New York City this morning. Good morning. Equity futures on the S&P 500 firmer here by 0.1%. The outperformance once again this morning. It's on the Russell. The small caps rallying big time. Under surveillance this morning, the big rotation.
As we come into earnings, I think the big question is, as we get this rotation, can it occur without selling of big cap tech to buy small cap? Does AI continue to lead the way, or do we get a rollover? And if we roll over, I think that's going to be so much pressure that even if small caps outperform, it's going to be in a down market rather than an up market.
So here's the latest. The rally in small cap stocks showing no signs of slowing. The Russell 2000 coming off its best 4-day run since 2020. Dan Greenhaus of Solace suggesting there's more room to run, writing this. This is not to say the mega cap tech names don't do fine, but at least for now, they have been trading a given valuation, might continue doing so. Dan joins us now for more. Dan, good morning to you, sir. It's good to see you.
Thank you for having me, sir.
Anytime. Let's start again. Good morning, Dan. It's good to see you.
Thank you for being here.
Anytime. Thank you, sir. Let's get into this.
Sure.
Small caps outperforming. A lot of people drawing the line to what's happening politically in Washington, particularly at the RNC overnight. Do you think we're reading too much into this?
Well, I don't think the small cap move really has too much to do with the RNC per se. And frankly, I don't think anything really has too much to do with the RNC at this point. Listen, the small cap story was one that a lot of us were talking about, not small cap, the mega cap story was one that a lot of us were telling coming into the year. That if you'd asked me, and people did, coming into the year, would I rather be long the S&P 493, so to speak, or the Mag 7? And my answer was the 493. And of course, that has not proven to be accurate. Small caps would fit into that discussion as well. The problem there is that you had that inflation interruption in the first quarter when you got a couple of 4/10 readings, and that put off any rate cut discussion. Now that discussion is not just reemerged, but in full swing, you're starting to see the type of action that people such as myself thought might happen to start the year. So I think that's largely speaking what's going on here.
So you don't think this is just a position squeeze? There's something fundamental. There are some tailwinds that might be durable through this year.
Listen, there's always a position squeeze. And I think you don't get the type of parabolic, dare I say, action that you're seeing right now without some positions being squeezed. But if you're asking me underneath it, is the reduction in rate expectations, the uninversion of the curve, so to speak, does it all play into the idea that that small caps might do okay-ish relative to large caps in the immediate future? I think the answer is yes. There is something fundamental there. Now, admittedly, I would say I don't love the small cap index and never have. I don't think most viewers can name 10 of the top 100 companies. Sure, Abercrombie's in there and Sprouts Farmers Market if you're an organic guy like me. But other than that, I don't think most people know a lot of those companies. I don't think they're particularly emblematic of any larger economic play, if you will. But to the extent that you think that these companies, and they are, more levered to floating rate debt, more debt in general, et cetera, a reduction in rate cut expectations is surely going to benefit them. And again, I think that's what's going on.
Yeah, you don't strike me as someone who spends a lot of time at Abercrombie & Fitch. Just a hunch. I know we've just met. But.
Well, ever since they got rid, no, I can't make the inappropriate
comment.
Well,
okay, fair enough. Okay, but you're talking about the positioning squeeze being part of it. But where we've seen that squeeze is on the most shorted stocks, on the small caps, on the unloved stuff. Where we haven't seen the squeeze is the over-positioning of the Mag 7. Those have mostly remained flat as the rest of the market has been catching up. Can that remain the trade?
Yeah, listen, I think, first of all, if you look at Apple and Tesla in particular, they are overbought and certainly are, like small caps, probably in need of a breather here. I think there's an argument that from a money flow standpoint, money can come out of the mega cap, so to speak, and into the rest of the market without there being a huge dislocation in the indices. But at the same time, if you're going to have some sort of a decline, obviously in Nvidia, Apple, et cetera, then for the most part, no matter how well the rest of the market does, at best you're going to trade flat. At worst, you're probably going to trade down a bit, even if underneath the headline things look a lot better than the headline suggests, akin to the way right now that the broader market isn't doing quite as well as the headline is suggesting.
I wonder if earnings can help us here, because Bank of America points out that Mag 7 earnings are going to slow down for the first time in some time from a high base, and the 493 are going to catch up again from a low base. Will that help some of this rotation?
I think it should. I don't think most people realize that we've had probably 4 or 5 quarters now where ex-tech, ex-financials, of course, but ex-tech, ex-Mag 7, ex-financials, you basically had flat to down earnings for, again, as I said, about a year and change now, 4 or 5 quarters, and you're just now starting to come out of this earnings recession. That should bolster the case for the rest of the market. To be clear, for Solus, we're nowhere near the mega cap names. We're scouring the market every day for both credit and equity for names that are unloved, that are overlooked. And there's a whole large portion of the market that is both unloved and overlooked. And I think there's ample opportunity here, and you're starting to see it peek its head out right now.
So you don't think the RNC or maybe Trump's pick of J.D. Vance is fueling small caps, but can we talk about what this ticket could potentially mean if we were to get Trump Volume 2? What kind of policies are you looking at and potentially investments you would want to put on?
Yeah, so I think we were just saying, you might say, well, energy is going to do great because Trump's going to drill, baby, drill. But I don't think most people realize that during the first Trump presidency, energy stocks were among the worst performing sectors. And during the Biden administration, which is perceived to be obviously more onerously regulatory of the energy environment, that energy stocks have been among the best performing sectors. So it's never so simple as just X is going to happen and therefore Y. That said, I think forgetting J.D. Vance for a minute, because I think Trump is obviously, as you well know, ideologically set, and I don't know that Vance necessarily moves the needle policy-wise, but the tariff story is probably going to be the big one that we have to wrestle with. I think we can assume that if Trump wins, probably the Senate and the House goes with him, And if you have unified government, you'll get the extension of the tax cuts. That's $3 to $4 trillion or so. So deficit and debt issuance is going to be a story. But the tariff is one we're going to have to wrestle with. I imagine the 10%, 60% discussion that's ongoing is a starting negotiation. But at the same time, the idea that tariffs are going to be put in place is probably something that's going to happen, the degree of which is an open question. What does that mean? I think it's certainly inflationary, all else equal, but is it necessarily bad? What sectors, what industries? That I think is going to be the largest conversation, at least initially.
We shared this earlier this morning, the Bank of America Fund Manager Survey. If we get the sweep that Dan is talking about, 77%, Danny, say higher bond yields, 52% say a stronger dollar.
Listen, I was talking to somebody just before coming on air.
I was speaking to Danny.
Yeah, we sound the same.
Come on. We look alike. We have a similar name.
Music's playing, Dan. We're going to break.
You just take the I away.
You guys go. You guys go. I'm monopolizing the time.
I think Dan stole my thunder.
Dan Greenhaus, thank you, sir. We're out of time. Up next,
and I don't even
he's
get
so
to
rude.
answer.
Maybe you'll be back, maybe you won't. Coming up next, Robert Koenigsberger of Gramercy Funds on the Trump trade. From New York City, you're watching Bloomberg Surveillance. Waiting for numbers from Morgan Stanley. As we wait for them to drop, let's check out the price action. Equity futures on the S&P 500 up a tenth. Once again, Danny Berger, the outperformance on the small caps, the Russell up 1 full percentage point.
There's a lot of things going for the index at the moment. A lot of the strength came post-CPI when we say, okay, maybe rate cuts haven't fully been priced into this, but you can't ignore the politics of it all. When you look at things like smaller oil and energy companies doing better, financial companies doing better, Jeffrey's out with a note saying that it is financials that are looking forward to a deregulated, more M&A-friendly environment.
Regional banks have absolutely surged up double digits over the last 5 days. Speaking of the banks, numbers from Morgan Stanley. Let's get to Bloomberg's Sonali Basak. Hey, Sonali.
John, when you look at some of the core numbers here, particularly those Wall Street numbers, we're looking at the trading desk. You do have equity sales and trading coming in above estimates at $3.02 billion. The estimate was for $2.7 billion. So meaningful beat at that equities sales and trading desk. You also have the wealth management revenues not as bright. You have them missing estimates to the tune of about $6.8 billion. The estimate was also 6.8, but 6.86. We got in at 6.79. Let's see if the market gives them a hard time. The beat, though, you also see here on net interest income is meaningful for Morgan Stanley. Of course, Morgan Stanley has been trying to lean into more of that lending revenue at its wealth manager in particular. You also see FICC sales and trading revenue beating estimates, coming in at $2 billion. That is a business that has been growing meaningfully over time at Morgan Stanley. Interesting, the rat race is over. We have all the numbers from the biggest banks. You do even with a beat over at equities trading. Goldman took the crown once again when it comes to that equities trading number there. We'll keep an eye out on how the stock trades. But again, you do have Morgan Stanley rising pre-market on those beats about 2% or so higher.
Sonali, you said it. That wraps up Q2. We've had all the big banks, the big players report. You typically grade them. Who won Q2?
It's hard to not say that JP Morgan won just because of how far they came in their returns on equity, their returns on tangible common equity of 28% in this environment, John, an environment where people are worried about expenses. Their net interest income of $22 billion, Bank of America, $23 billion nearly. Bank of America, Citigroup brought in about $13 billion. They're guiding higher for the year. Story gets really interesting when you think about those rate cuts and how that might impact these banks moving forward.
Sonali, Morgan Stanley up in a pre-market by a little more than 2 full percentage points. Sonali, thank you. Under surveillance this morning, that wraps up bank earnings on Wall Street. Bank of America, a little bit earlier, delivering better than expected net interest income and trading revenue. As Sonali broke down just moments ago, Morgan Stanley reporting a beat on equity trading revenue, but a miss on wealth management net revenue. Elsewhere, another story to look at. Former UN Ambassador Nikki Haley is expected to speak at the Republican National Convention later on today. Donald Trump reportedly called Haley his one-time rival after he was shot on Saturday to invite her to the convention. Last week, Haley said she was releasing her delegates and encouraging them to support Trump. New tariffs of 60% on Chinese exports to the U.S. would more than half China's growth rate, according to new research from UBS. This comes after reporting earlier this year that Donald Trump is considering a flat 60% tariff on Chinese goods. To discuss, Robert Koenigsberger of Gramercy Funds Management joins us around the table. Robert, good morning to you, sir.
Good morning.
Big tariffs we could potentially face. I think we've all sort of got volume one, Donald Trump down. We understand it. Tariffs, what it means for the world. If we think about the arc of that tariff effort, initially there was a big focus on things like NAFTA. It was about Mexico. Then it was China later on. What do you think the arc is this time around? How are you thinking about things in EM?
Well, I guess it is helpful to go back and look at what happened in 2016 in EM as Trump came in. And I think there's a couple lessons. One was this immediate trade-off of the markets and with very little differentiation, perhaps a little more impact on Mexico than elsewhere. But if you look from November of 16 to by February 17, so 30 days after Trump had been in, all of that down trade had been recovered and it was all in positive territory. Now, of course, 16 perhaps was a bit more of a surprise, the Donald Trump victory, than perhaps it might be in 24. So a lot of the Trump effect is starting to be priced into markets already. You saw that in the steepening of the curve yesterday. So as we go forward, I wouldn't be surprised to see some volatility, but I think you're going to see some differentiation between Asia and particularly China and Latin America.
Are you seeing that differentiation yet? Are you hearing that as well?
Starting to, but again, the China trade and the headwinds of China and tariffs, all that, I think it's been, more properly priced this time around.
Who would benefit outside of the United States if actually you were to see manufacturing come back to the U.S.? Who in EM would benefit from this trade war, which potentially we're going to get?
Sure, I think you'll continue to see a trend that's underway, and Mexico's a big winner. And we have a large private lending business in Mexico. And we've seen a lot of opportunities that have come out on the onshoring and the nearshoring in Mexico. Obviously, India has also been a big beneficiary. But, I think when I look at LATAM today, you could say LATAM is going to be a winner, but I think you can also start to differentiate the different regimes and those that look more to the right, more to the left. And I think it's going to be beneficial for the Argentinas, maybe even the El Salvadors, maybe a little more challenging for Brazil and Colombia.
When it comes to Mexico, though, doesn't Trump need to make sure that there isn't a back door for Chinese companies to still they're exporting into the United States just under a different flag?
Yeah, I think that's a great point. A friend of mine who has been doing manufacturing in China for 35 years in textiles just made a trip to Vietnam. And he said, because all of the businesses has moved to Vietnam. I said, well, that must be challenging. He said, well, it's all the same people. They're just moving to Vietnam. And I think you're seeing that in Mexico as well. It's going to be one of the challenges that are faced.
And I think that's an excellent point, that it's not just Mexico. It's elsewhere in Asia, too, which leads to the confusion, the unknowingness for 2025. What does that mean just in terms of investment and businesses willing to make these sorts of deals, to do these sorts of partnerships, when we just, frankly, to your point, don't know what it will look like?
Yeah, I mean, I think it's about trying to tease out where you can have the best conviction. And in our world, it's about trying to figure out how to be beta agnostic and really structure investments, transactions, what have you, so you can be more agnostic to those risks. One have to expect the risks. There's a lot of unknown knowns and what have you. And so it's all about the structure. It's all about the detail. And the devil's all in the details and how you negotiate a contract, how you implement a contract, whether it's on financial investment or direct investment.
Well, it's this tension we've seen play out in markets over the past week, this push and pull of, do I care about the economy or do I care about politics? Where do you stand on the spectrum right now?
I mean, I think ultimately the economy matters. And when I look at different regimes in Latin America, for example, you can see all sorts of volatility around the politics. But oftentimes, if the economies themselves are anchored, you can have change in politics, and politicians, but you have a change in regime. And if you have regime change, then you should expect policy change. But oftentimes, it's not the regime that's changing, it's just the name of the leader.
Let's talk about regime change, actual regime change, and just the typical market characteristics of things like treasuries, DM versus EM. My cheat guide, and you're the professional, not me, but my cheat guide for the distinction between the two is often what happens when things go bad. In EM, you sell it. In DM, you buy it. That's what happens with treasuries. We used to see that in Europe, particularly in bonds. Things have changed a bit in Europe. I want to understand if things change here in America. When things start to go bad, whether it's the economy, whether it's politics, whether it's governance issues, do treasuries rally anymore? Do they start to behave like EM? Are we turning the world upside down?
Yeah, I mean, these are great points. I mean, if you look at in the post-COVID era, I think EM led the way in terms of good policy vis-a-vis the U.S. and some of the developed markets, raising rates faster. And, they didn't have the flexibility that some of the developed markets had. But, I guess when you look at the U.S., you still have to think, well, what's the alternative, right? And that's the problem. There's fundamentals and then there's technicals. So where are you going to go? That's the challenge.
Is there anywhere in EM that you'd suggest you could go?
Yeah, but I think it's, for us, it's less about where in EM and how to approach EM.
Talk to me about that. What's different about the approach?
Yeah, I used the notion of beta agnostic before, and we were just talking about policy. But I think, within emerging markets, I think you can go in and get the high expected return without making a call on beta and do it by kind of this active tacit asset allocation and really anchoring in high conviction yield, owning things that you want to own, not owning an index because JP Morgan told you to own a certain credit. And then waiting for opportunistic credit when it's really opportunistic, special situations when they're really special, and distress when it's really distressed. And I think, we've seen a lot of mistakes that folks have made in emerging markets for 25 years. It's usually about buying the wrong thing at the wrong time, sticking with it for too long, and then capitulating, and then wondering once again why it didn't work. And so we think there's a better approach to less about making a call on the asset class. If you think about it, when you talk to your guests about developed markets, it's not about yes or no DM. It's about how to play it at any given time. But EM tends to be this afterthought. Should we be in or not? Should we be in beta or not? And we think that's one of the big mistakes that folks have made historically.
When you say special situation, describe that to me. In the past, historically, what has been a special situation? Said, this is really special, I got to go in.
Sure. Special situations can be anything as simple as some of the sovereign debt restructurings that we've been involved in for the past, 35 years as individuals or 26 years. Some of the special situations that we're involved in today, for example, may be around late-stage litigation finance, both in emerging markets and out of emerging markets. And what makes them special is you're able to structure the transactions, get a really high coupon and return, but we've been able to do things like wrap it with insurance to be able to get principal protection or even minimum returns. So you create these asymmetric return profiles that look more like call options than bonds.
When you look at the United States and you say, well, there's really nothing else that is on the same caliber, do you think we're at peak U.S. exceptionalism?
That's hard to call. I think I think there's cycles and it wanes and what have you. I think for this cycle, the exceptionalism has been pretty strong. But again, I'm not sure where it's going to come from in the short term.
I want to ask you about China specifically, because we've been getting a lot of data over the past couple of days, and it does paint a dour picture. A consumer who still isn't picking up, soft GDP numbers, despite continued exports of things like EVs and semiconductors. That's been the model. No support overall, but continue to pump out goods. Is there a limit to how much that can help China in the recovery?
Yeah, I think the elephant in the room for China is the property sector, right? You got to go back to the Evergrande crisis, and I think the goal of the government was to isolate Evergrande and insulate the rest of the sector. But again, real estate's 25-30% of GDP. So to ignore, everyone keeps waiting for the bazooka. There's just been little drips of aid, but to ignore 25 or 30% of the economy is just doesn't make sense.
We've been waiting for the bazooka for how long? That turn of phrase, we've been using it for so long. Isn't there a certain point where these drips add up to something? Why is this so chronically underloved in a struggling sector when there has been support, and you could argue things have been adding up?
Well, I think if you look at some of the data, even this morning in the housing sector, if you look at the year on year, it still looks pretty anemic. But we're starting to see a bottoming out and actually small growth on month to month. So it's all about confidence, right? There's certainly an inventory overhang. You mentioned, this export-oriented economy. Well, that's not creating a lot of confidence for the consumer. And the consumer's got problems in real estate, but they have problems in employment and elsewhere. So it's complicated.
Can I just finish with your conviction trade? The way you described EM, I think is really interesting because that's typically how we all talk about it. On or off, long or short, in or out. It's very, very binary. What's your number one position right now that you're super confident about and telling the world all about? What is it right now?
Yeah, and we've talked about this in the past, but I think the special sauce in emerging markets today, at least for us, is the ability to do private credit, asset-backed lending, like developed markets 10, 15 years ago, where you can go in and get high expected returns. You can mitigate your risk through structuring and collateral. Take a quasi-sovereign oil and gas in Latin America. A bond maybe trades at 5%. It's got collective action clauses. It's got trustees. It's got all sorts of challenges. You can lend to the suppliers of that same company get the company guarantee, and then go and get uncorrelated collateral, hotels, shopping malls, whatever it may be, and get 1,000 basis points, 10% more yield, I'd rather do that all day long and not have to figure out the hardest thing to figure out, which is beta.
Robert, super smart and wonderful to hear from you, sir. Thank you. Robert Koenigsberger there of Gramercy Funds on emerging markets. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's get across to Yahara Hackers. Hey, Yahara.
Hi, John. Let's recap those Morgan Stanley earnings. Shares are lower in the pre-market, a miss on second quarter wealth management net revenue, overshadowing a beat on equity trading revenue. The bank's CEO, Ted Pick, saying it remains well positioned to deliver growth and long-term value. Earlier, Bank of America reported better than expected net interest income and trading revenue. Verizon is exploring the sale of thousands of mobile phone towers across the U.S. That's according to people familiar with the matter. They say the biggest wireless carrier in the country has hired advisors to gauge interest from potential buyers. A sale could bring in more than $3 billion for the phone company, which declined to comment on the report. Back in 2015, Verizon sold the right to lease and operate about 11,000 towers to America Tower Corp for $5 billion. And in a home run derby first, a Los Angeles Dodger has taken home the trophy. Outfielder Teoscar Hernandez won the showcase event last night in Arlington, Texas. He beat out Kansas City Royals rookie sensation Bobby Witt Jr. in the final round, 14-13. New York Mets All-Star and two-time Derby champion Pete Alonso was eliminated in the first round. The festivities culminate tonight with the MLB All-Star Game. That's your Bloomberg brief. John?
Yahara, thank you. The only thing I heard about this was the national anthem. Did you hear about this?
Oh, that it was like the worst national anthem ever to be sung?
I've not heard it yet.
God.
I'm going to do that in a commercial break.
Don't
you
do
heard
it.
it yet?
I feel bad for her. No, don't listen.
Was it
don't
her? I've got no idea.
Yeah, it wasn't.
Okay.
It wasn't good.
All right. Still going to listen to it in a commercial break. Up next on the program, Donald Trump picks J.D. Vance.
President Trump was right about every single disaster that Joe Biden was wrong about. NAFTA destroyed the manufacturing economy in Pennsylvania, Michigan. A real estate developer from New York, Donald Trump, was actually right about that issue.
That conversation up next from New York. This is Bloomberg. For the record, you might have guessed, I can't sing. I can't sing.
Neither can I.
I can't sing. It's pretty bad, all right? It's pretty bad.
I feel bad saying it, but it is pretty bad.
Yeah, that
Maybe
anthem's not good.
Couldn't
That
hear
rendition.
herself. I honestly feel so bad for her. It's painful.
Okay, it's pretty painful.
It's painful that because John mentioned it, I had to go listen to it, and I'm never going to get that minute back in my life.
We can't sing. None of us can sing. Apparently, she can't either, all right? Equity futures on the S&P. That was a bit harsh. That's a bit harsh. Equity futures on the S&P firmer by 0.1%. Under surveillance this morning, Donald Trump picking J.D. Vance.
President Trump was right about every single disaster that Joe Biden was wrong about. NAFTA destroyed the manufacturing economy in Pennsylvania, Michigan. A real estate developer from New York, Donald Trump, was actually right about that issue. Letting China into the World Trade Organization, Joe Biden supported it. A real estate developer from Queens named Donald Trump opposed.
So here's the latest. Donald Trump picking Republican Senator J.D. Vance of Ohio as his running mate. Once a critic, now a fierce defender, Vance is known for his populist policies, the 39-year-old calling for increased tariffs, stricter banking regulation, antitrust enforcement, and has been very critical of aid to Ukraine. So when you see this picture in the equity market, the S&P up just 0.1%, the Russell of small caps surging once again, this time by 0.9%. How much of this picture is really about the prospect of another round of Trump policy? Let's get into it with Chris Verrone of Strategas, a bed company. Chris, good to see you, sir.
Great to be here.
Big rotation underway. Some
big.
people trying to work out, is this just about rates, about the economy? Is it also about politics? Where do you stand on that?
I think, when you look at what's really driving this move, financials as an example, I think it's a combination of really three things. Certainly the move in rates, I would put at the top of the list here. This is a very, very big breakdown in two-year yields. Look at the UK twos this morning, breaking below 4% for the first time in maybe 2 years. So there's certainly a rate element to this. There's the political side to this as well. And as we know, I think this is a market that's pulling forward a Trump win. The leadership profile looks remarkably similar to what we saw in the weeks following the 2016 print. So you have that as well. Then you have, I think, the macro, which I would describe as still certain sectors justifying the soft landing call. I think financials, when you look at the past soft landing, 1995, they were the big winner. So their leadership here, I think, speaks to this really threefold story. You have political, you have soft landing, and you have rates down. I think that's really catalyzing this leadership.
Politics, rates, macro.
Yeah.
Of those three, do you think some are more durable, sustainable than others?
I think the rate story is the most important of this. I think it's the most durable of this. We have put a major top in bond yields. We're going to 350 on 2-year yields. We're going to maybe 3.25 or 350
You
on
say
10s.
that with conviction like you know. Where does that come from?
I'm a trend follower, and the trends have changed all year. Really, for 6, 7, 8 months, these have been trends that have been transitioning lower. And when you look at the global picture as well, yields are breaking down everywhere. German 10s have failed here again, the UK 2s, the Swedish 10s, the US 5s, the US 30s. Something has changed meaningfully in the bond market.
Even so, we're still expecting 2 rate cuts this year. If we're talking 50 basis points, how much is that really going to help a sector like the small caps? We have all this floating rate debt. Is 50 enough to really revive the trade?
I think we're in a little bit of a reverse situation from late 21, where, frankly, the market began to demand rate hikes. I think the market is now going to start to demand rate cuts. I mean, the 2-year yield right now is trading basically 100 basis points below Fed funds. Even after the ECB cut a few weeks ago, German 2s are trading about 100 basis points below the ECB policy rate. The market is demanding, I think the Fed is going to do more here.
Okay, so in that world where the Fed does do more, in terms of the sectors themselves, if you look at something, again, like a small caps, where we're heading towards a soft landing, they're okay. What in there makes sense to you? Because to John's point, it has been the policy that's been leading it. It's been the financials. Is that what leads this?
Well, it's the largest weight within Russell 2, so financials participating certainly helps the story. But think about the inverse of this for a moment. When you had the non-recessionary rate cuts in summer 95, what worked and what didn't work? Financials roared, tech struggled. Lower rates were not a boon to tech. And, you know, I think some of the best clues that markets give can often be very subtle. The last 3 or 4 weeks, even before last Thursday, banks were breaking out. Semis were not making new highs. NVIDIA, Qualcomm, AVGO, Micron, they all peaked back in the middle part of June. Those last 3 or 4 weeks, they were not involved. Watch these stocks here. We know how robust the enthusiasm has been. We know how massive the flows have been. They're starting to crack here a little bit. You know, all these AI-related power stocks have also started to crack here the last few weeks. So I think lower rates will not be the boon to that group that perhaps many expect. I think the financials are telling you that's where the momentum is.
Let's talk about the politics.
Yeah.
When Trump won in 2016, he came out, he was talking about infrastructure. And then it became an ongoing joke in Washington, D.C. Everything was infrastructure week, and then actually it took Joe Biden to get a bipartisan deal done. With that said, if you're bringing forward a Trump trade, what are the risks that actually you're wrong, this does not pan out?
You know, I think the risks are that the bond market is telling you that 2 feet are coming off the accelerator next year. And, you know, what's underpinned, I think, a lot of the economic momentum has been stimulus over the last year plus. And you begin to wonder if, you know, first year presidential cycle next year, if it's a change in administration, does the foot come off the accelerator, particularly on the fiscal side? Is that what the bond market is starting to reflect and pick up? And remember, this is a yield curve that's steepening. We know what the historical message of that is. When you start to get a curve that's been inverted for a long time come out of inversion, it typically means you're not too far off from some recessionary environment. So I think that has to be a risk for 2025. First year presidential cycle tends not to be particularly good either. I think in the interim, I think we have 4, 5, 6 months here where this market's still in good shape.
Just to get into that a little bit more, does it matter how the curve steepens?
Absolutely.
Because the kind of steepener that you're talking about, I think, is the bull steepener, the rate cutting cycle.
Yeah.
That wasn't yesterday.
I mean, 10-year yields are now below where they were at yesterday's low.
Granted, accepted,
right?
Valid point.
2s have gone from 5 and change to 440 and change. Sounds like a bull steepener to me.
That's what you're looking for.
That's what I'm looking for.
Donald Trump doesn't change that.
I think it accelerates it.
It accelerates the bull steepener. Okay. Get into that. Tell me why. Because a lot of people might think more supply, inflationary presidency, longer end sells off. Why does it accelerate the bull steepener?
So if you remember November of 16, you got a bear steepener out of November of 16 as the market began to price in kind of economic reacceleration, deregulation, all of that. There's a lot of equating of what we've seen with this steepener the last couple of weeks, really post-debate, to that moment. But the subtle difference, as you know, John, this has been a bull steepener. Why has it been a bull steepener? Because I think the market is beginning to pick up the idea that you're going to lose some of the fiscal support in 25 that you had in 24 and 23. And I think ultimately at the end of the day, it means nominal bond yield lower, particularly on the short end. You could convince me maybe 10s and 30s hang out around here, but I think we've lost twos. I think we lost twos for this cycle.
But you just said Trump presidency might accelerate it. I want to understand why. Why would it accelerate that move?
I think the likelihood that we have the same fiscal impulse in 25 that we had in 24 is low. And I think, therefore, the message of the bond market is one of slower growth, not more robust growth. And I think the short end reflects that.
Okay. Chris, good to see you.
Always a pleasure.
Super smart, as always. Chris Verrone of Strategas, a bad company. On that steepener, looking for that bull steepener to continue.
That feels quite contrarian at this moment. I mean, it's
that's out of consensus.
Well, considering that it is a market that has not been trading that way at all, but I think to Chris's point, you need to rethink a lot of things. If that is the case, you need to rethink this equity market. You need to rethink the health of big tech in that environment. Again, if low yields also means they're not doing well, I think we got quite a few things to reckon with.
We've got a lot to talk about this morning and maybe for the rest of this year. Coming up on this program, Republican Congressman Mike Lawler of New York, Greg Daco of EY, and Andrew Husby of BNP Paribas. More still to come from New York. The third hour of Bloomberg Surveillance up next.
The conventional wisdom right now is going to be that this is Trump's election to lose.
Joe Biden and his campaign, even with all of the dysfunction, should not be counted out just quite yet.
There isn't a Trump trade or a Biden trade. You have to put Congress in the mix.
U.S. assets are probably likely still going to be attractive to the global community.
I think geopolitical risk continues to ramp up this summer.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now with equity futures on the S&P firmer by 0.1% after a major rally in this equity market over the last week. We'll dissect that rally in just a moment. In about 30 minutes' time, retail sales in America, the data point to watch. Chairman Powell says he's a little bit more confident about the trajectory for inflation. We want another read on the U.S. consumer. And then later, an address by Nikki Haley, of all people, at the RNC in Milwaukee, Wisconsin. A preview of that a little bit later on the program as well. The challenge we've all got in financial markets right now, look at the outperformance in small caps. How much of this is about the macro backdrop, the rate story, the politics? I want to sit on the politics. The challenge I think we've all got right now and for the next 4 months, the difference between how Donald Trump will campaign and how he might govern.
Well, and also now who his VP pick is. This is someone that around this table we've almost coined king of the small cap, someone who likes small business, does not like big business, does not like big tech. And that pick yesterday from Donald Trump signifies the not just tilt toward the populist wing of the party, it's a full pivot, which is why this evening is going to be so interesting, because there's a big gap between the Nikki Haley's and the J.D. Vance's.
I also think on foreign policy, J.D. Vance is a big signal in how he's going to govern. Speaking to Fox yesterday, saying that China is the U.S.'s number one threat. He also spoke to Politico over the spring, saying that he's all for dollar devaluation. So a lot of this, which the market has said, is just campaign rhetoric. It's going to calm down. I think if you have another guy in office alongside you who believes exactly the same thing, it's hard to just say, it's just rhetoric.
Yeah, so this gets really tough. Let's go to the fund manager survey from Bank of America, and we'll go through those stats for you again. This according to their survey. What happens if you get a sweep? Red or blue? This is what people think. 77% say higher bond yields, 52% say higher US dollar. It's the dollar piece of this that I think gets interesting. If you're saying that basically Senator J.D. Vance does not want a stronger dollar, and most people in foreign exchange markets come on this program and say, if you deliver those tariffs, that's what you'll get, what will they do?
Well, they only have so much power to devalue the currency when they want to do things like, again, tariffs, when they are all for kind of building up the economy. That's such a huge part of their platform, especially when you're talking about small businesses. Devaluing the dollar only goes so far at this point, not to mention that J.D. Vance is going to have to go out to the Senate and kind of whip everybody up out in Congress and say, hey, believe in our policies. A lot of people in the Senate don't like him, both from the GOP and from the Democrats. He opposes a lot of them.
What happened to King Dollar under Larry Kudlow? I think this is where there's some contradictions here that we need to figure out what this is actually going to look like going forward, which is why, once again, I think it's tremendously difficult to work out how different campaigning might be from how they might govern over the next 4 years if they can.
And it depends also if they're going to bring the likes of individuals like Larry Kudlow back into this kind of administration. I'm glad you brought up the Senate. I was shocked yesterday. Well, I guess not that shocked given this full pivot to the populist wing of the party. But when your Senate Minority Leader Mitch McConnell was on the floor, he was booed yesterday. Foreign policy is going to be incredibly interesting today. He's a foreign policy hawk. He wants to give more money to Ukraine. This is Senator McConnell. So does Nikki Haley. That is something J.D. Vance does not want to do.
The Haley address, one to watch a little bit later. Let's get to the price action. Equity futures on the S&P 500 firmer here by 0.2%. That's the equity story for the big caps, for the S&P. The small caps outperforming once again. We've talked about that bond market sell-off just yesterday. Well, there's a rally this morning. Yields are lower by 5 basis points. The 10-year 4.1750. Coming up in the hour, we'll be catching up with the Republican Congressman Mike Lawler on enhanced security for presidential candidates. Greg Daco of EY with retail sales 30 minutes away. And David Rubenstein on Powell's growing confidence in 2% inflation. Under surveillance this morning, dissecting a security failure.
Ultimately, this is going to fall in the Secret Service. What were the manpower requests and were they granted? What was the timeline for the agents who were arriving from out of town and being briefed? For my 22 years, I don't think I ever worked a site where I felt like, yeah, we got plenty of people here. There's always holes to plug.
There were some big holes on Saturday evening. Here's the latest. Officials trying to piece together Saturday's security failure at Donald Trump's Pennsylvania rally. Secret Service Director Kim Cheadle telling ABC there will be immediate changes, including expanding tactical support for Trump. This is two New York Congressmen, Mike Lawler and Richie Torres, are introducing bipartisan legislation that would increase protection for presidential candidates Trump, Biden and Robert Kennedy Jr. I'm pleased to say that joining us now is Republican Congressman Mike Lawler. Congressman, thanks for sharing some of your time this morning, particularly how busy things have been for you over the last couple of days following the events of Saturday evening. Can you walk us through just the content of your bill and the kind of changes that you'd like to see?
Well, we're working through the logistics right now and plan to introduce this week. But the intention here is to ensure that President Trump, President Biden, and RFK Jr., whose family has twice been victim of political assassination, have enhanced security. Obviously, as more information is uncovered about the events on Saturday, it raises serious questions about what level of security the former president had. The fact that a armed shooter was able to get on a roof with a clear line of sight at the former president and get a shot off that went through Donald Trump's ear, but not for the grace of God, we'd be having a very different conversation right now. So, the fact that this was able to happen, there's been lots of questions about, the lack of resources, the lack of air support, if you will, as well as the use of drone technology. Lots of questions being raised that require immediate and serious answers. And this cannot be a, cover your own ass situation. This has to be a full and transparent investigation into what happened, why it happened, and how to ensure that this never happens again. Our elections must be determined by votes at a ballot box, not by violence at a rally. And obviously, the Secret Service has a responsibility to ensure the safety and well-being. And this cannot be a question of expense or resources. The federal government has a responsibility to ensure the safety and well-being of these candidates and to ensure that every resource necessary is available to them.
Congressman, I think many of your colleagues on the other side of the aisle also agree with you. But just from a logistical point of view, how quickly can this bill get passed and then we actually see those resources hit the ground?
Look, obviously, this is a question for leadership on getting this bill to the floor as quickly as possible. I'm heartened to see that the Biden administration did move yesterday to give RFK Secret Service protection after many months of him requesting it. And obviously, the head of the Secret Service saying that there's going to be immediate changes with respect to President Trump's detail. But we need to make sure as a Congress that we are ensuring that the resources are there, both financially, and that there is more stringent requirement on providing this security. I mean, it shouldn't have taken a shooting on Saturday for them to realize that President Trump needed enhanced security and that RFK Jr. should have security. That should have been a no-brainer in this heightened political environment in which, look, we're a deeply divided country. And obviously, we've seen incidents in recent years, attacks on members of Congress, threats against sitting governors, violence against, the former speaker's husband. So this is critical in this moment that we recognize the seriousness of this, the threat, and that Congress acts both in terms of ensuring the support financially and otherwise for the Secret Service, as well as these congressional investigations that are going to get underway next week when we get back to Washington.
Congressman, given we are a deeply divided country at the moment, following that assassination attempt, the now VP pick of President Trump said that this had ties back to Biden. Do you think that kind of rhetoric is appropriate coming from the VP candidate?
Well, first of all, the investigation obviously is underway. We don't yet know the motivation of the shooter, and that will come out in due time, and we should allow that process to play itself out. I think what the vice presidential nominee was alluding to in his comments is the continued assertion that Donald Trump is a threat to democracy or a fascist, or that if he somehow wins in November, that therefore American democracy is going to end, is destructive. It's destructive to our country. It undermines our democracy. It undermines our electoral process and should stop. And I think all of us can recognize the need to bring down the temperature several notches, to look at the rhetoric that is being used. Both Republicans and Democrats have a responsibility here in this moment of heightened political disagreement, that we really recognize the importance of the moment. As I said before, our election should always be determined by votes at a ballot box, not by violence at a rally. And all of us have a responsibility to understand that words matter. Our rhetoric can, at times, cause harm, and we need to be clear that we're not going to tolerate it. And I think what the vice presidential nominee was alluding to in that is that the continued effort to somehow say that Donald Trump getting elected is going to destroy our democracy needs to stop.
And Representative, to be clear, this was, of course, a shocking event over the weekend and deeply disturbing to anyone. But it is not the only case of political violence. You only need to look back over the past few years, whether it be the insurrection on January 6th, whether it be Nancy Pelosi's husband being attacked. I want to understand from you the temperature read that you're getting at this moment in this country, what you're hearing from constituents. Are we starting to dial down the temperature? Does this weekend represent a peak to you, or how concerned are you still of this deeply divided rhetoric that we continue to hear?
Well, if this doesn't shock our nation's conscience to its core, I don't know what would. Look, I've been very clear over the years. I was the first Republican member of the state legislature in New York to denounce the events of January 6th on January 6th. I spoke out when Nancy Pelosi's husband was attacked. In the same way, I'm speaking out about the assassination attempt against President Trump. All of us should be universally clear in this. Political violence has no place in our democracy. There should be no tolerance for it wherever it occurs, whether it's those that, seized control of a federal courthouse in Portland, burned down a police station in Minneapolis, or stormed a Capitol on January 6th. It should never be tolerated or condoned, period.
Congressman, appreciate your perspective. Thanks for making time for us this morning. Thank you, sir. Mike Lawler there. Congressman Mike Lawler on the latest effort to provide extra security to officials across this nation. Equity futures on the S&P positive here by about 0.1% on the S&P 500 with an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hekes.
Hi, John. Shares of Morgan Stanley lower in the pre-market. A miss on second quarter wealth management net revenue overshadowing a beat on equity trading revenue. The bank CEO Ted Pick saying it remains well positioned to deliver growth and long-term value. Earlier, Bank of America missed estimates for net interest income in the second quarter, but said the key metric would climb by the end of the year. Those shares are higher. GM is backing away from its goal to produce 1 million all-electric vehicles. CEO Mary Barra saying at an event yesterday that the company won't have production capacity in place to build 1 million EVs at the end of next year, which was its previous target. The CEO adding that customer demand will dictate how fast the company can get to the 1 million mark. But for now, she says they're seeing a slowdown in EV deliveries. And President Biden will unveil a new proposal today to cap rental costs across the country. His plan would give landlords a choice, agree to cap rent hikes at no more than 5% per year, or give up coveted federal tax breaks. The measure would need to be approved by Congress, where it faces steep odds. It would have to pass a GOP-controlled House and win a supermajority in the Senate. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, Donald Trump picks Senator J.D. Vance.
President Trump was right about every single disaster that Joe Biden was wrong about. NAFTA destroyed the manufacturing economy in Pennsylvania, Michigan. A real estate developer from New York, Donald Trump, was actually right about that issue.
Up next on the program, former World Bank President David Malpass from New York City this morning. Good morning. Counting it down to the opening bell, 1 hour and about 13 minutes away. Equity futures on the S&P firmer here by 0.1%, and bond yields a little bit lower. We're down 5 or 6 basis points on a 10-year to 4.1731. Under surveillance this morning, Donald Trump picks Senator J.D. Vance.
President Trump was right about every single disaster that Joe Biden was wrong about. NAFTA destroyed the manufacturing economy in Pennsylvania, Michigan. A real estate developer from New York, Donald Trump, was actually right about that issue. Letting China into the World Trade Organization, Joe Biden supported it. A real estate developer from Queens named Donald Trump opposed it.
Here's the latest. Donald Trump picking Republican Senator J.D. Vance of Ohio as his running mate. The 39-year-old supporting increased tariffs, stricter banking regulation, and antitrust enforcement. David Malpass, the former World Bank president, joins us now from the RNC in Milwaukee, Wisconsin. David, it's always wonderful to catch up with you, sir. Thanks for making time for us this morning. This is a man that you know quite well. Walk us through what we need to know and how you think this administration might change, might be different to what we saw the first time around with Donald Trump.
Hi, John. Good to see you. Well, one thing is high energy, so that's going to, I think, help. We need a lot of U.S. leadership within the world. Another theme from last night that was very clear is the working person in America. You know, I'm a nerd, so we talk about median income, raising the median income. That's what I've worked for 40 years. And that means what's the wage of the people in the middle of the economy? How do you get it up? And there was a lot of talk, of course, last night about manufacturing. J.D. Vance is a great choice as you think about how do you get people in jobs in rural areas, in suburban areas that are manufacturing jobs that are making things again. That speaks directly to Michigan, to Ohio, to Wisconsin, to Minnesota, and so on around. I'm from Michigan, and manufacturing is a key part of the state.
David, if I can match that with the conversation on Wall Street, just to get across to here, there are some conversations taking place about foreign exchange. You know Larry Kudlow, you know him better than I do, we both know him well. Larry Kudlow would often talk about the strong dollar policy. You don't hear that so much from Senator Vance. Some might say you hear the opposite. What do you think is going to change on that front?
We saw in the platform that the U.S. is going to protect the reserve currency status of the dollar. That means defend the dollar. You know, I use the phrase strong and stable dollar. That means 50 years from now, you will know that the U.S. dollar is the stable store of value for the world. That's the best thing for manufacturing because you can make the new investments. I think the key is to create an environment where people want to invest in the U.S. There was the Teamsters Union head last night gave a really strong endorsement to President Trump, talking about breaking the political caste system and creating an environment where corporations wanted to be in America because they could produce here. That's going to be especially true of energy. You can create energy and mining huge value in the U.S., and that enables all of the manufacturing and the technology sectors of the country.
What do you make of, though, Mr. Vance talking about, and he's questioned Jay Powell about this as well, the fact that the reserve currency status of the U.S. dollar worries him and the lack of control we have of our own currency. Does that bode with some of the members, as Jonathan was saying, in the former Trump administration, like Larry Kudlow?
I think the Fed made big mistakes. You know, I've been writing about that in the Wall Street Journal for well over a decade. The idea of having 0% interest rates didn't defend the dollar, and it didn't work for getting investment into the U.S. So you can have a much stronger policy from the Federal Reserve. I think that's some of what people are getting at, that the Fed needs to be talking about production in the U.S. as a way to bring down inflation, and that will bring down interest rates. So I think there is a huge complaint right now that interest rates are the only tool being used to try to bring down inflation. That's not the right way to go at it. And it means that the little guys, small businesses across the country, are feeling the pain. The interest rates are too high for small businesses, and it's feeding into the concentration of wealth at the top.
David, I just want to understand that. Just give me some more colour. How are you thinking about the Federal Reserve? Are you saying they need newer tools, more tools, or are you saying the emphasis should be elsewhere in Congress?
They have lots of tools. They have regulatory tools that really affect how lending is done within the country. They're not doing it in order to help small businesses. They need to be thinking about that. Also, the trade-off between the balance sheet and the interest rates, I think, can be done in a more effective way. They don't need to be owning all the bonds of the U.S. government. They're helping, you know, how is it that we're in this environment where central banks buy the bonds of their governments, and that enables big government spending? So you can change that in a way that's very pro-growth. And I think that also plays into making the dollar the reserve currency of the world. China is looking at it saying it sure looks to us like the United States has lost its way. It's chasing its tail. And that can be fixed, I think, pretty quickly by communicating clearly that you want a strong, independent Fed that is talking about the actual needs of the country as a way to bring down inflation and bring down interest rates.
David, you just sounded like you were saying that you think they should accelerate the balance sheet roll-off and get out of the Treasury business. And I'm trying to sort of match that up with the prospect of extending the tax cuts of 2017. How do you do both those things at the same time? You know financial markets better than most. What was that going to look like?
They all go together, and they actually work toward growth. I think if they would shrink the balance sheet, remember the balance sheet has two sides, assets and liabilities. The liabilities that the Fed is using to hold all those bonds is short-term liabilities. They have this giant leveraged trade on that's lost a huge amount of money, maybe $1 trillion of losses from that trade. They can let it run off in a way that puts money through the private sector, so it actually gets to small businesses. Think how better the environment would be if we had lower short-term interest rates, and that I think can be achieved by talking about growth, about the dollar, defending the dollar, and about having more investment in the U.S. You'd have more confidence in the country and in the future, and that really was the theme at the convention yesterday.
You clearly have a very clear policy preference, David. I just wondered, do you have a clear preference on who you would like to run the Federal Reserve?
No, that's not so much the issue as the policies. We need good people in strong positions in order to turn the country around. I've written a lot about the need for a full upheaval of policy thinking, and especially the models at the Fed. They're still basically operating under the Phillips curve model that in some way you have to have unemployment in order to bring inflation down. And I think that can be switched around to say, look, if we have more people working, you're going to get lower prices and lower interest rates.
One of the bad things about TV, David, is you run out of time. And this is one of those conversations where I needed an extra 30 minutes to get more clarity from you. David, let's do it again soon. Thanks for making time for us. David Malpass there, the former World Bank president, and some of the changes, Danny, we might be seeing.
Yeah, I'm really interested about that balance sheet comment.
Right?
I need to think a little bit more about that one, I'm going to be honest.
Got to try and get some more clarity on the push here. The extra tools they could use,
right.
The extra things they could be doing,
right.
How that sort of is compatible with the stronger dollar at the same time.
And how it ultimately helps small businesses. Again, the wheels are turning.
There's a lot to discuss on all of these points. Coming up next, retail sales in America from New York. This is Bloomberg. Counting you down to retail sales in America with the scores like this on the S&P 500. Equity futures shaping up as follows. Firmer by 0.1% on the Nasdaq, up by 0.25%. The outperformance on the Russell. Once again, the small caps up by almost 1%. In the bond market, 2-year, 10-year, 30-year looking a little something like this. The 10-year down by 6 basis points. Down 6 to 4.16. We're down 5. On a 30-year to about 4.40.24. With your retail sales numbers, let's get across to Mike McKee. Good morning, Mike.
Good morning. A little bit better performance for the American consumer than anticipated, though not great. Retail sales come in flat for the month of June, after being up 0.1%. But the forecast was for a 0.3 drop, so there's some good news there. Ex autos is 0.4 gain, and when you look at the retail control group, it was up 0.9%. I want to check when I get a chance in a second to see what happened with autos, because remember there was that power out or computer outage for a lot of the auto dealers. And so auto sales suffered in the month, and that might be one reason we were only flat. Import prices come in flat. Ex-petroleum up 0.2 on a year-over-year basis now. Import prices are up 1.6%. That's going in the opposite direction of what we anticipated. But overall, John, it looks like a relatively good retail sales report. I'll check the details now.
And Mike McKee, that control group is 0.9. That's a big upside surprise. The estimate in our survey was 0.2. You put that together with jobless claims from last week, which was better than expected. You start to build the impression that maybe just that shaky period in the economic data was a bit of a head fake. We'll see. But ultimately, it's 2 data points that support the idea this economy, the consumer, is holding up okay. In the equity market, in response to that, let's go through the boards and start with equities and look at equity futures. On the S&P 500, we're firmer by 0.2%. We had some more weight to the small caps rally, up by 1.1%. In the bond market, the 2-year, 10-year, 30-year, we had yields down by 4 to 5 basis points, down about 5 or 6 at the longer end through much of this morning. On a 10-year, we're now down by about 4 to 4.19. So we give some of that up. If you turn to foreign exchange, the euro against the dollar, euro-dollar looks like this. Completely unchanged at 108.93. Mike McKee, let's get into that just a little bit more. The totality of the data, the Fed's favourite phrase. Do you think that shaky period for the consumer was a head fake, or do you think the jury's still out?
I think the jury is still out. The question has been, will the rise we're seeing in wages and salaries make up the difference from the disappearance of people's pandemic savings? And so far, it appears to be doing that. When you look under the hood here, we had a negative 2.3% drop in autos and other motor vehicle parts, but they fell 2.7% the prior month. So it's or a year ago. So it's partly seasonal here, but everything else for the most part is up except gasoline. And you'd expect that. Gasoline prices have been going down. That was down 3%. So you take that out, sporting goods and hobby stores down 0.1%. Everything else was up, including non-store retailers, 1.9%. Remember, they had fallen in the previous month, and people were questioning why that is. What should be interesting this month is, of course, we're right in the middle of Prime Days, and that tends to drive retail sales at non-store retailers a little bit higher.
Well, on the topic of goods and sales there, Mike, we've been seeing in the data this disinflation or at least deceleration that was coming into the fore. Is there any sign of that in these numbers?
Well, these numbers are not adjusted for inflation. So you can take away the inflation numbers from it, and the numbers come in still very good because inflation was low and these numbers were high, especially when you look at the 9/10 gain in the core group. If you have to seasonally adjust by category, inflation adjust by category, so I can't do it off the top of my head. But it does show there's still strength in there even without inflation.
Mike McKee, thank you, sir. On the latest, this is a strong data point in America for retail sales. It's what we call an upside surprise. To break it down, Greg Daco of EY alongside Andrew Husby of BNP Paribas. Greg, I want to come across to you first, sir. Your reaction to this data. Is the shaky period for the consumer over, or is the jury still out?
What we're seeing is just generally more prudence. I don't think we're seeing any form of retrenchment in consumer spending activity in this type of June report, which was quite strong across the board, as Mike was just highlighting, is indication that consumers are not pulling back, but they are being more judicious with how they spend, how much they spend, and where they spend. And that's still the reality today, despite this fairly favorable report. Let's not forget, you still have a jobs market that's still adding a decent number of jobs, 180,000 on a 3-month moving average, and wage growth is still around 4%. So combine the two, you still have that income support. It's not any sign of a retrenchment, but it is more prudence on the part of consumers.
The Federal Reserve for a while has pointed to the consumer, the labour market, and said the strength there is a reason to wait. It gives us the luxury of time just to see how the inflation trajectory changes, evolves. Greg, do you think they have that time? Can they wait? Can they skip July and wait until September?
I think we're not talking about necessarily bringing rates down to zero or cutting rates in an emergency fashion. What we're talking about is really recalibrating monetary policy. And I think now would be optimal to recalibrate monetary policy now that the labor market is rebalanced. You probably don't need as restrictive monetary policy now that the labor market is rebalanced and now that inflation is continuing to move to the downside. What you want to do is sustain the economic expansion in a low inflation environment that calls for a recalibration of monetary policy. I've been discussing this for a few months now. I think now would be optimal to recalibrate monetary policy. June would probably also have been good as well.
Andrew, let me bring you into the conversation. Get your first read and whether you kind of agree with Greg here, whether still now is the time to act.
Yeah, I definitely agree with Greg here. This is a consumer that's taking a breather after a pretty solid sprint over much of the pandemic here. So what we've seen in the consumer sentiment data is some fatigue about high interest rates and higher prices. But this is not, as Greg said, a consumer that's kind of rolling over. And the labor market is a key part of that. Income is still growing, wages are still growing, and really the economy is not really set to really take a dive right now.
The balance of risk around the dual mandate has clearly shifted. And you can see that with the communication coming from Chairman Powell. The focus now, can we say, is equally on CPI, it's equally on price stability and full employment?
I think if they're not going to say that exactly, basically that's where we are right now. It's a Fed that's going to be very attuned to weakness in the labor market, the jobless rate above 4.1%, the economy probably slowing below trend in the back half of this year on our estimates. So it's a time where they can think about recalibrating policy lower here.
Greg, with all the things of lining up to be able to recalibrate, Jan Hatzius probably agrees with you, and he even goes so far as to put a note out yesterday saying, why wait? If everything is lining up, why wait 7 weeks? Would you agree with that July actually makes sense?
I think June might have made sense. I mean, you're really talking about recalibrating monetary policy gradually. You want to avoid a situation where you're reacting to a more significant slowdown in economic activity. That's really the risk right now. As John was saying, you have an equally balanced environment when it comes to the downside risk on the labor market front and the easing of inflation. So now is really the time to gradually recalibrate monetary policy, do so with a lot of regard towards how the data is evolving, but gradually move towards a state where interest rates are more in line with potential growth for the economy and an environment where inflation is continuing to move towards 2%. So yes, I would agree with Jan Hatzius there in terms of easing monetary policy now and not necessarily waiting until September.
Andrew Honhorst of Citi yesterday put out a piece and the title read like this: rate cuts go from if to when to how many. On the if, not a matter of if. I think we're all waiting for that move. On the when, debate about whether it's July, September or shortly afterwards. I think we can park that. Let's talk about the how many. Greg, when you start to adjust, are they talking about a fine-tuning, a mid-cycle adjustment? What kind of adjustments are you actually looking for? And how on earth, and this is the difficult question, can we make that call for 2025, given the kind of political conversations we're having in this country?
We tend to focus a little bit too much on the years, right? There's nothing that says that there have to be a certain number of rate cuts in any given year. We're anticipating a couple of rate cuts this year in September and December, given what we've heard from policymakers. And we're anticipating about 125 basis points of further easing in 2025. But as you said, there's a lot of uncertainty, whether it's political uncertainty, policy uncertainty, geopolitical uncertainty, that comes on top of the macro uncertainty. So the direction of travel of the economy is one in which you're seeing a gradual slowdown in the pace of growth, which warrants a recalibration of monetary policy. We're in the early stages now, and I think the Fed would be well placed now to gradually recalibrate and allow itself some time to observe how the economy is evolving while recalibrating the pace of monetary policy tightening.
The only thing certain right now is the uncertainty. But if we could pick up, Andrew, on the politics, how are you thinking about 2025? Because the Fed could be looking at a set of policies that are very different.
Yeah, it's certainly a key catalyst, obviously. Here we're talking about tariffs, taxes, other issues related to potentially labor supply as well. The key catalyst for us, we think, on the inflation front, the Fed might be thinking about or might have to think about in short order is tariffs. We did put out a pretty extensive note last month, and certainly there's a lot of detail that's left unsaid right now about what that might exactly look like. But illustratively, you're looking at inflation that could be a percentage point, couple of percentage points, or even several percentage points higher than the base case right now. So that, with the Fed having gotten inflation roughly in the neighborhood of where it wants to, it hasn't gotten it all the way home yet. So that's going to be potentially something that's going to be a key.
Does that mean a hike potentially in 2025?
So that'll be, so with cuts priced in right now, one way you could look at it is basically just a hold for longer. But certainly, depending on the mix of policies, you could be thinking about hikes potentially after some cuts. So that you've seen in the past. Andrew
Husby of BNP Paribas together with Greg Daco of EY, both trying to figure out the future here, which is tremendously difficult to do in 2025. We could see some big changes. Danny, big changes to trade, big changes to the Federal Reserve. I just want to reflect on the conversation we had with David Malpass, the former World Bank president, who was talking about maybe shifting the emphasis of the Fed's balance sheet away from supporting the Treasury and towards supporting small business. These are some big ideas.
One of the things that I kind of struggle with that is it is more than just supporting the Treasury. Part of their balance sheet and part of why you've seen them even slow their runoff is to avoid financial shocks. That is a big factor of this. So if you say, okay, we need to completely run this thing down. I mean, what happens when we enter a COVID period where there are issues of liquidity in the system and the Fed doesn't have that base? I think if you take that out, sure, you maybe can make Malpass's argument, but I mean, it's kind of an elephant in the room.
What happens if you have the administration come out and talk about the extension of the tax cuts as they are already, and that collides with the Federal Reserve that wants to aggressively roll off the balance sheet away from treasuries even more? This is really complex stuff and tremendously difficult to work out what's going to happen. What Fed policy looks like in all of that, I've got no idea.
And I mean, will it even be Powell? He says he wants to stay until 2026. That's a big question of it, too. By the way, did you hear Powell talking about dinner and how he doesn't go out to dinner anymore? With David Rubenstein,
I missed that.
He told David Rubenstein that he doesn't go out to dinner in public anymore because people listen to his conversation. He only eats at home and over at friends' houses.
That sounds really sad, doesn't it?
It does sound sad. I mean,
okay.
I would be one of those
people.
But
why is he worried about his conversations being heard?
That's a good point.
Does he talk about policy out for dinner?
That's a very good point.
If he does, John's going to start stalking him.
I tried to do that at Jackson Hole once. Tried to listen to some of the conversations.
What was he eating?
Yeah, it wasn't Chairman Powell, someone else. OK, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Retail sales for June delivering an upside surprise, coming in unchanged after economists had expected a drop of 0.3%. The Retail Sales Control Group, which excludes food services, auto dealers, building materials, and gas stations, rose 0.9%. Well above the median projection of 0.2%. Investors now looking ahead to a slew of Fed speak this week for clues on the central bank's path forward. Elon Musk is throwing his weight behind Donald Trump, pledging to pour $45 million a month into a pro-Trump super PAC. This coming after Musk's public endorsement of Trump over the weekend. The billionaire's cash infusion likely to help build Trump's fundraising over President Joe Biden, who is now suffering from a donor revolt over calls for him to drop his candidacy. Other donors to the America PAC include crypto billionaires Cameron and Tyler Winklevoss. And Donald Trump, the presumptive GOP nominee, announcing Ohio Senator J.D. Vance as his running mate on the first day of the Republican National Convention. The pick signals what's likely to be a pro-tariff ticket. Trump earlier this year reportedly said he was considering a flat 60% tariff on Chinese imports, and Vance, in one of his first interviews since being named Trump's running mate, called China the biggest threat to America. That's your Bloomberg Brief. John?
Yara, thank you. Up next on the programme, we'll set you up for the day ahead and we'll catch up with David Rubenstein. All of that just around the corner. From New York, this is Bloomberg. Counting it down to the opening bell, equity futures here positive by 0.25%. Bond yields a little bit lower. We're down by 2 basis points now, 420.80. Just a moment ago, had a really nice retail sales print. Upside surprise on retail sales in America. Here's the trading diary for the day ahead in the next few days. Nikki Haley will speak at the RNC a little bit later on. Wednesday, we'll get the Fed's beige book, and Trump's VP pick, J.D. Vance, will take the stage in Milwaukee, Wisconsin. Thursday brings another round of jobless claims and Netflix earnings after the closing bell. Plus, Trump delivers his nomination speech that evening. A programming note for you. Joining us right now is David Rubenstein of the Carlyle Group and host of Bloomberg Wealth. His latest interview is with Philippe Lafont of Cotu Management. He is the founder of that company. You can watch it on Bloomberg TV at 9 p.m. Eastern Time. David, wonderful to catch up with you, sir. We've got tons to talk about this conversation. We've got to talk about your conversation with Chairman Powell as well, and the VP pick too. Can we just start with Philippe Lafont? What do we need to know about this gentleman, and what can we look forward to later this evening?
Philippe Lafont is an immigrant from France who came here at the age of 16. He worked for Julian Robertson after he got his degree from MIT, and he built one of the largest hedge funds in the technology space. It's about a $50 billion hedge fund, and he's had successes through up and down times in the economy, and I think he's considered one of the best technology investors in the country, and he's built a really wonderful reputation for investing in technology companies in the United States and around the world.
David, while we have you, we have to talk about your conversation with Powell. You tried very much so to get something out of him in terms of when he might move. Some even chuckles in the audience as you did that, but he stayed very steadfast. What was your takeaway from that interaction?
Well, he's very experienced at not saying anything that will get him in trouble. Obviously, he's not going to make any comments unless they're official comments, and he wouldn't make those until after there's been an FOMC meeting. So I think he's very polite. He's very smart. He's worked with me over the years at Carlyle, but he doesn't tell me anything that he shouldn't tell someone like me. So I couldn't get him to say anything other than, that he'll have an FOMC meeting and they'll look at the data and they'll do what the data suggests. So that's all I know. I don't know any more than I knew before, I guess, really. But I'm glad he did the interview and he gave some insights into what it's like to be the Fed chairman, because obviously it's everybody's paying attention to every word you say.
And David, you caught up with him a few times, though, in the post-pandemic world. The inflationary challenge in front of him at the time, how difficult it was. It just feels like that's slipping into the background, and the focus is shifting a little bit more to the labour market. Can you give us your impression of how the arc of your conversations has shifted somewhat over the last few years with him?
Well, clearly, when inflation came, it was not recognized as being as enduring as it turned out to be. The Fed chairman and the Secretary of Treasury and others said it was transitory. They recognized later it was more enduring than that. But I think the Fed did a really good job of increasing interest rates without putting us into a recession. As you may recall, people were predicting that the high interest rates would produce a so-called hard landing last year and a hard landing this year, and it hasn't happened. And so now we're at the point where interest rates are likely to be lowered, and we haven't had the hard landing that people predicted. So I think the Fed deserves, along with others, some credit for managing this high inflation period of time.
David, I'd love to get your thoughts and reaction to what we found out last night, which is the VP pick for Donald Trump. It's going to be J.D. Vance, really emblematic of this pivot of the Republican Party to the populist wing. Who do you think represents the pro-business interests in America now?
Well, I was somewhat surprised by the selection only because, he's young. He's 39 years old. We've had young vice presidents before. But I thought, he added less to the ticket than some of the others, but obviously Donald Trump, knows what he's doing in terms of politics. He seems to be, pretty successful in that area. I would say I knew J.D. Vance before he got involved in politics. He was working for Steve Case at a startup kind of venture fund to invest in companies throughout the United States, but not just in Silicon Valley or New York or Boston. And that, called Rise of the Rest, was a fund that J.D. Vance was working at, and I invested in the fund. But before the fund was completed, he left and did something else. So I met him in that context. That was before he was involved in politics.
David, did you invest in the fund because you also were interested in the individual?
No, it was Steve Case who had the track record of and the concept of investing in technology companies that are not just in Silicon Valley or Austin or Boston. And so it was investing throughout the Rust Belt, among other places. The idea was that there are good technology companies there as well. And so that was the idea. And because I guess J.D. Vance had been from the Midwest, he was thought to be a pretty good guy to invest in that kind of company. And so he did that for a while. I think he left after maybe a year or so to do something else in Silicon Valley.
David, what do you think the business environment needs to expect now, given the potential of a second term with Donald Trump and some of the thoughts that we've heard already from Senator J.D. Vance on things like antitrust, on regulation of technology, on mergers and acquisitions? What do you think's in store? And is the Republican Party of old? How much has it changed over the last few years? Is it still that traditional pro-business movement?
Well, obviously, the Republican Party of the 1950s, 60s, and 70s is not the Republican Party of today. It's different. I think trying to predict what the party is going to do and what Donald Trump is going to do if he's elected president is very difficult at this point because he hasn't picked all of his advisors. But it's clear that Donald Trump controls the Republican Party, and it's pretty clear that he's got a very good, healthy position today as he goes forward. It was sad to see, obviously, that the shot at him over the weekend. We're very fortunate that he was not more severely injured because, as we all know, a half an inch either way, it would have been a very tragic accident for the country and for his family. Fortunately, that didn't happen.
Absolutely horrific. But David, you did not answer my question originally, so if I could just get back to that. Which party is now the pro-business party?
Well, both parties have certain pro-business elements, and business people will complain about both parties on certain areas. So I don't think it's fair to say either party is the pro-business party because there's businesses, so many different types of business. But clearly, the Republican Party today is different than the Republican Party of 20 or 30 years ago or when I worked in the White House more than 40 years ago. And clearly, the Democratic Party is different than the Democratic Party of 30 or 40 years ago. So the world's changed, not surprisingly. I think both parties offer some things for the business community and some things the business community doesn't like. But I think it's too early to say what President Trump would do if he were elected. And it's too early to say what President Biden would do if he were reelected. It's just too early because we're just too far away from dealing with the economic situations that we'll see in next year.
Well said. David, it's fantastic to catch up with you, sir. David Rubenstein there of the Carlyle Group. You can watch David's interview with Philippe Lafont a little bit later at 9 p.m. Eastern Time on Bloomberg TV. This has been a theme for this programme over the last 3 hours or so, the difference between campaigning and what you can expect when they start governing. And to David's point, it's tremendously difficult to work out what it will look like when they start governing, if they start governing.
Absolutely. We're hearing a lot of rhetoric. We need to see what that would transform and that would mean for policy. I will say, though, the pick of J.D. Vance, for those within the Republican Party that thought potentially they were going to go back to traditional conservatism, traditional pro-business, that is not the pick. This is a pivot to the populist right, which is why it's going to be so interesting tonight when we hear from Ambassador Nikki Haley, especially when it comes to foreign policy. She still wants more funding and support for Ukraine. There's a lot of circulation happening of what J.D. Vance has said in the past about Ukraine, at one point saying, I don't really care what happens to it either way. They're very different tenors of the Republican Party.
It's true, but again, where there is something united, it's on China, and at least for J.D. Vance and Trump, it is the dollar. Again, when we're saying how much is J.D. Vance going to be able to influence Trump, on some of these things you can say, okay, the pick of J.D. Vance was about campaigning, but some of these things, it's about governing. They are so closely aligned. I don't know about the antitrust element. I don't know how much Trump is going to sign on to that. But again, there are things that are very strong. They're both in it together.
This pick inks Donald Trump as the populist wing. His wing of the party is now taking control of the GOP. And I think that this pick really solidifies that. But also, J.D. Vance is going to help him in the states Biden needs the most. The one issue that's going to come up is the individuals in those energy districts in Pennsylvania are already going to vote for J.D. Vance. It's the women in those districts. Who do they go to?
For the markets, could it be the small caps presidency? Counting you down to the opening bell, 35 minutes away. Equity futures on the S&P up by 0.2%. The small caps is where the outperformance is this morning. Yields a little bit earlier. We're down by about 5 basis points at the long end. Given the retail sales number we got 25 minutes ago, we undo some of that. It unwinds. We're down by about 2 basis points on a 10-year at 420.99. And the dollar comes back a little bit stronger with that move. Euro dollar 108.78. Tomorrow, here's the lineup for you. Brian Nick of New Edge will catch up with Tobin Marcus of Wolf Research and a man who was in the running to become the VP, Virginia Governor Glenn Youngkin, sitting down with Anne-Marie at the RNC. We'll catch up with Mike Schumacher as well of Wells Fargo on this bond market. Much more still to come from New York City this morning. Good morning to you all. This was Bloomberg Surveillance.